So let's get started. I'll request all of you to please switch on your cameras. Okay, so today and tomorrow we'll complete fixed income. Let me share the screen. I've been able to get a permission for one extra session on fixed income from the institute. Okay, so I think in the last class we had done till which topic? We did with the market for corporate issuers, for government issuers. We did with the bond valuation as well, right?
Yes, we did the forward pricing, forward rates part.
Always forward rates. Oh yeah, this one. Okay. So we have to get into interest rate risk and return part, right? So
Mm.
let's see, make sure like we didn't leave anything on reading 57 and then let's go from there. Okay, yeah, this forward rate calculation we talked about, the logic and also the formula about it. Cool. Right. Now the interest rate risk and return. Now this is another important slide, I would say. Sorry, chapter, I would say, especially like this part, the 5 key results. This is like a very loaded page, and I'll try to take it as slow as possible. Let me share an Excel sheet. Okay, now in this case, just to recall what we have said so far is, let's say if the face value of a bond is 100, the coupon rate is, let's say, 10%, and let's say if the market rate is also 10%, the market value of the bond will be equal to 100. We all are comfortable with this part? So this is a scenario when the bond is trading at a par. If, let's say, the coupon rate is 9%, the bond will be trading at a premium, and then I would say it's a case of a premium. And in case of a discount, this being same, maybe the market rate is 11%. That's the reason the bond is trading at a discount. May I request all of you to please switch on your cameras? I see only Rishabh and Ria and Samay with their cameras on. Savik, Nandini, Anushka. This part you all are very comfortable with, right? Now, tell me one thing. What is your sense? Ki, what is better? Market rate being lower is better, or market rate being higher is better?
Lower, sir.
So yes, you're right. Based on what you have discussed so far, lower the market rate, better it looks. Okay, if the market rate is lower, you'll sell the bond at a premium and make some money out of it. But this is true if and only if you're a short-term investor. Let's say if the maturity of the bond is 10 years, and if you want to hold the bond at the end of 10 years, what do you get at the end of 10 years? Do you get the premium price or do you get the face value?
Yes, premium, sir.
No, you won't get the premium, right? If you sell the bond after 10 years, the
Okay.
company will buy it back at the face value, right? And remember, we did a concept called pull to par.
Yes,
The
sir.
value of the bond keeps decreasing towards par. So the entire thing we have discussed so far in fixed income is attributed towards a short-term investor. Because for short-term investor, what is important is how much do you get by selling the bond today? So the bond selling at a premium, the bond selling at a discount, these are all the current near-term things. In the long term, towards the maturity, the bond will trade near its face value. So this 110, oh sorry, this 110, the 10 rupees of premium will keep decaying over the life of the bond. And the bond value will go towards 100. And this discount of 10 rupees will keep narrowing. And by the time it's towards maturity, it will be trading at 100. So if you're a long-term investor, this 110 or 90 rupees doesn't matter to you because at the time of maturity, you'll get your 100 rupees back. So as a result, let's try to understand that if you invest money in a bond, what all do you get in return as an investor? So there are two important things which is very, very straightforward. One is coupon rate. ये तो चाहे तुम short term investor या long term investor हो, everybody will get this. No doubt about it. The second component you get is capital gain or loss. And the third component, which I'm not sure whether you thought about it yet or not, is your reinvestment income. तो खाली एक बार अपन प्रीमियम बॉन्ड की बात करते हैं. And let's make two cases out of it. Let's say we have got Ria, who is a short-term investor, right? She all wants to is invest money today and get the money out after 5, 6 months or 3 months or 1 year. She's a short-term investor, we'll call it. And let's say we have got Sovic, who is a long-term investor. Okay? And the bond I'm talking about is a premium bond. So what I'm saying is, in this case, let's put a horizon as well. Let's say Ria is going to invest for 1 year, and here Sovic is going to invest for 10 years. Let's not bother about coupon rate. How much coupon rate Ria will get in the first for 1 year? 10%. How much Sovic will get every year for the next 10 years? 10%. So coupon rate is the least thing I want to bother about because both of them will get the same return. The capital gain or loss. Let's say the market rate has gone down to 9%. The bond value will go to what? 110? Congratulations, Ria, you got a profit of 10, which is capital gain or loss. But what about Sovic? How much capital gain or loss he'll get at the end of 10 years?
Zero.
Sorry.
Sir, zero.
Yeah. So let's call it near zero. So let's say he's not investing for 10 years, but let's say 9.5 years. So it's pulled to par, but because just like 6 months before the maturity, there will be some premium left in the bond. But the other important thing is the reinvestment income. What is reinvestment income? Starting के अंदर Ria thought कि I will get a particular rate of return by investing in this bond. And that time the market rate was 10%, right? When she invested initially. But now the market rate has gone down to 9%. So the problem here is that whatever interest she is getting from the company in the form of cash, in the form of coupon rate, she thought that she'll be able to reinvest that money at 10%. But because the market rate have gone down, she's not able to reinvest at 10%. She's able to reinvest only at what? 9%. So on that 10 rupees ka coupon, she's losing out 1% for 1 year. If you do the math, she's losing out 1 rupee. I'll say it again. Initially, at the starting, the market rate was 10%. तो रिया ने क्या कैलकुलेशन किया होगा कि whatever coupon she gets at the end of half year, she'll be able to reinvest at 10%. And whatever interest she gets at the end of 1 year, she would not be able to invest because उसका investment horizon is 1 year. So actually, I'm sorry, it's not even one rupee. She'll lose out only on 50 paisa. What is this 50 paisa? On a half yearly basis, she's getting a coupon of 5 rupees, which she thought she'll be able to reinvest at 10%, but she's able to reinvest only at 9%. And not even 50 paisa, she'll lose out only 25 paisa. Because she's losing out interest only for 6 months on 5 rupees. But it's not relevant how much she'll lose. But is it clear what she's going to lose is very, very small amount? क्योंकि उसका investment horizon is 1 year. But come to Sovik. On the first 10 rupees in the first year, he'll be losing out 1% every year for the next 9 years. On the second 10 rupees he's getting at the end of second year, he'll be able to reinvest only at 9% rather than 10%. He'll lose 1 rupee for the next 8 years. And so on. I don't want to get into the math, but it's a significant loss. Okay? So what we are saying is कि अभी what we are talking about is if the market rate is lower, is it good for the short-term investor like Ria? Yes. Because the capital gain or loss she's going to get from this is so much more than the reinvestment income she's losing out on. But for a long-term investor, the capital gain or loss is less relevant. And what is more relevant is the reinvestment income. And as a result, for the long-term investor, higher the market rate, better it is. So guys, there could be a medium-term investor, I don't know, 4 years, 4.5 years, 5 years, 6 years, or somebody. That's a calculation which we'll be doing. But let's say there's a medium-term investor. Let's say Varun is a medium-term investor. And that's possible that that medium-term investor will get the same 10% return as others, whether it's a short-term or a long-term investor. For this person, the capital gain or loss will not be that much relevant. Why? Because after 5 years, the premium will decay to some extent. So I'm not saying it'll become zero, but it won't be 10 rupees as well. Let's say the capital gain because of the premium on the bond is 5 rupees. But the loss on the reinvestment income, because the money will not be able to reinvest it at 10 rupees, sorry, 10% will be reinvested at 9%. That loss will also be significant because that person on the first 10 rupees will be losing out on the next 5 years at the rate of 1%. On the second 10 rupees, you'll be losing out for next 3 years. So if you do the calculation, there's a possibility that the loss from the reinvestment income is same. And this investor will say, I give a damn about market rate. Because Whatever I gain on the whatever I lose on the reinvestment income, I'll gain on the capital gain or loss. So it depends whether you're a short-term investor or a long-term investor, whether you're going to benefit with a decrease in the market rate or not. What we have discussed so far is that you're a short-term investor. If you're a short-term investor, market rate going down, the capital gain and loss will be quite significant, and the loss on the reinvestment income is very, very minimal. So we presumed that for all the investors, lower the market rate, better it is. But that's not true for the long-term investor. For the long-term investor, higher the market rate, better it is. And there could be a medium-term investor for whom whether the market rate goes up or the market rate goes down, it's irrelevant. So I'll stay here. Take a look. If you want, I'll repeat all of it, but take some time to digest, take notes, or ask me questions.
So this reinvestment income 0.25, this where I have struck it. Sir. Can you please re-explain that?
Okay, so what is reinvestment income? अगर if your investment horizon is 1 year, initially तुमने सोचा था कि whatever coupon I get from the company, I'll be able to, let's say I'm getting some money at the end of 6 months. How much money will you get at the end of 6 months? You'll get 5 rupees. पहले your
Yes.
plan was कि my investment horizon being 1 year, what will I do with this money at the end of 6 months? I want to reinvest this money for the remaining 6 months. Right? So your plan was that you'll be able to reinvest that 5 rupees at the rate of 10% for the remaining 6 months. And you would have got a total return of 10%. But now, because the rate of interest is 9%, you're not getting 25 rupees, 25 paisa, you're getting 22.5 paisa. So you're losing out on 2.5 paisa. Sorry. So you're losing out on 2.5 paisa. Very small amount you're losing out on. But the long-term investor, investment horizon being 10 years, उसको पहले लगा था कि I'll be able to reinvest this 5 rupees for the remaining 9.5 years at 10% and would have got 4 rupees 75 paisa in the form of interest. But now the problem is that the rate of interest in the market has gone down to 9%. So he will not get 4 rupees 75 paisa, he'll get only 4 rupees 28 paisa. So how much he's losing out on? He's losing out on 48 paisa on this money. Same next year, sorry, at the end of 1 year, he'll get another 5 rupees. He had thought that he'll get this money invested for 9 years, but he's able to invest this money only for a what? At 9%. He thought he'll get 10%, but he's getting 9%. He's losing out what? 45 paisa. So I'm saying that if you do the extension, so he's losing out so much of money. Oh, sorry, it won't work like this. He would have thought like this money will be reinvested for 8.5 years. This money will be invested for 8 years. And I can keep doing it. But technically, you're losing out this much of reinvestment income because the market rate has gone down. So if you go to the market and park your money, you'll be losing out the interest on that money.
This one for long terms.
For the long-term investor, yeah. So we don't want to get into numbers here. It's very, very qualitative. That for the short-term investor, this reinvestment income this person is losing is very, very small. But for the long-term investor, the money this person is losing is quite significant. And the capital gain and loss for the short-term investor is quite significant, but for the long-term investor is very small because of the pull to par concept. For long-term investor, higher the market rate, better it is because the focus is on the reinvestment income. And for the short-term investor, lower the market rate, better it is, because the focus is on the capital gains.
So if the market rate is more, the long-term investor will think to shift his investment to another bond, right?
कैसे बताओ? तो
मतलब
those
now it's 10%. Suppose it increases to 11%. We'll think to reinvest the whole bond in that rate also.
हाँ, तो let's say if this is the current scenario, the market rate has gone up to 11%, right? So
Yeah.
now this person has got two options. Either stay, okay, give me 1 second. So if this particular bond, which was trading at, sorry. Okay, so your point is that let's say a particular long-term investor who was holding this particular bond with a coupon rate of 10% and the market rate of 10%, the market rate has gone to 11%.
Yes.
So rather than buying this bond, he will buy another bond which is offering 11% coupon rate, and the market is also 11%. So the bond will be trading at 100 rupees. Is this what you're suggesting?
Yes. Yes.
But why will he shift out of this bond? Because when he sells this bond, see, to be honest, he'll be indifferent between this bond and this bond. Why will he be indifferent between these two bonds? In this bond, he will be able to sell this bond only for 90 rupees.
Yeah.
Right? But he'll be buying this bond for what price? 100 rupees.
100.
So there'll be a loss of 10 rupees. But यहाँ पे coupon rate इसको ज्यादा मिल जाएगा. So that will be compensating.
Yes.
So there's no difference per se. Guys, give me 1 second. So at any point of time, if there was a clear thing कि यार ये this bond which is the existing bond is better than the new bond, the market won't work, right? Then everybody will be crowded in one bond and nobody will be buying the other bond. So I'm saying in this case, I'm indifferent. That I continue holding this bond. The benefit of holding this bond is I don't have to incur a loss of 10 rupees. If I buy this bond, I'll have to sell this bond, incur a loss of 10 rupees, but then I get a higher coupon rate.
Okay. Got it.
So guys, you have to do it very, very logically rather than mathematically to understand the concept here. Okay. Now, in this case, let's say I'm taking a scenario that the coupon rate is 10%, the market rate is 10%, the bond is always trading at 100 rupees. In this case, if the market rate has not changed, is remain same as the coupon rate throughout the life of the tenure. Now, whether you invest for 1 year, you invest for 5 years, you invest for 10 years, your returns will be same. Because in that case, what will happen is both of them are getting the same coupon rate, which is 10%. All three are getting the same 10%, whether you're short term or a medium term or a long term. Because the market rate is always 10%, there's no capital gain or loss. Everybody will be selling it at a par. And there's no loss on the reinvestment income because you thought you'll be able to reinvest it at 10% and you're reinvesting at 10%. So this problem becomes important or relevant only when the market rate changes during the tenure. If the market rate doesn't change, the short term, the medium term, and the long term investors, everybody will get the same rate of return. So, guys, if you understood this, you'll understand these 5 points. And these are very critical, very important for your exams. So, I'll do it as slow as you want. An investor who holds a fixed rate bond to maturity will earn an annualized rate of return equal to YTM. In our example, the market rate is 10%. So that person will earn 10% if the YTM of the bond does not change over the life of the bond. So if that 10% remains 10% throughout the life, every investor, whether you're a short-term investor or you're a long-term investor, you'll get the 10% return. Straightforward. An investor who sells a bond before maturity will also earn a rate of return equal to YTM if the YTM has not changed since purchase. So this is irrelevant whether you hold the bond till maturity or you sell the bond before maturity. The first point is technically about the long-term investor. See, who holds a fixed rate bond to maturity is a long-term investor. An investor who sells a bond before maturity is a short-term investor. But in both the cases, both of them are getting the returns equal to the YTM, which is equal to 10%. But let's start with point number 3. If the market rate for the bond, market rate or the YTM, 10%, has increased to 11%, our assumed reinvestment rate increases. The reinvestment income will be more. And that's relevant for who? The long-term investors. An investor who holds the bond to maturity will earn a realized return that is higher than the original market rate. क्योंकि उसको लग रहा था कि he'll get a reinvestment income only at 10%, but now he's getting a reinvestment income at 11%. So that person will benefit. What we discussed, right? So for the long-term investor, what matters is the reinvestment income. And higher the market rate, higher the reinvestment income. Oh, if the market rate is more, the bond will be trading at a discount. But who cares about it if I'm going to hold the bond till maturity? If the market YTM for the bond increases after the bond is purchased, but before the first coupon date, a bond investor will earn a rate of return that is lower than the market rate. So that's exactly the same thing. If you're a short-term investor, if the market rate goes up, you benefit in the form of higher reinvestment income, but that's for a very, very short period. But you lose lots of money by selling the bond at a discount. So if you understand this part, guys, I think these loaded statements should be very easy and convincing for you to understand.
Ansh, can you please repeat once more the last 3 statements
Uh, from the PDF or from the Excel sheet?
on the PDF? Like, you couldn't understand the last
Which, like number 3,
3, 4, and 5.
3, 4, and 5. Yeah. Okay, let's start. If the market rate increases after the bond is purchased, the person who is holding the bond till maturity will earn a realized return that is higher than the original market rate. So what we are saying is they're taking a scenario like this. The market rate has gone up to 11%. As a result, the bond is trading at a discount. If you're a long-term investor, you initially thought that whatever returns you get from the company will be reinvested at 10% in the market. But now you're getting 11% by reinvesting the money in the market. So you're getting 1% more throughout the tenure. Oh, on the other side, you'll be losing out on the selling the bond at a discount. But if you want to hold the bond till maturity, there will be a pull to par and there's no discount. You get what the face value is. Right?
Yes, understood. So it will be beneficial for the long-term investor because they will get a higher reinvestment return. But for
Exactly.
a short-term investor, it will be not good because their the capital appreciation will be less due to the
Absolutely.
increase.
Absolutely. So if the market, see, that's the fourth point. If the market rate increases, a bond investor will earn a rate of return that is lower than the market rate if the bond is held for a short period. उसका भी reinvestment income ज्यादा होगा, but that person will be losing out a lot more on the capital loss side because he doesn't want to hold the bond till maturity. And if you sell the bond now, the bond will be sold at a discount. And rather than 100 rupees, you'll get only 90 rupees by selling the bond. Same thing for a long-term investor. If the market it goes down, the total returns go down because the reinvestment income will go down. Oh, the bond will be trading at a premium, but how does he care? Because at the time of maturity, the bond will be sold at a face value. So see, what happens is that whenever we invest money in a project, let's say I'm investing money in a 5-year project. At the end of first year, I'm getting 100 rupees. At the end of second year, I'm getting 150 rupees. At the end of third year, I'm getting 175 rupees. At the end of fourth year, I'm getting, let's say, 125. And at the end of fifth year, I'm getting, let's say, 75. So what I do is if I want to see what is the total money I'm getting from the project, I will not keep this 100 rupees idle, right? I'll invest this money somewhere else for the remaining 4 years, either back in the project or somewhere else. So in this case, I'm assuming that given the project is giving me 100 rupees, it means there's no scope for the money to be reinvested in the project itself. So I'm investing this 100 rupees somewhere in the market. And this money will be reinvested for how many years? 4 years. This money will be reinvested for how many years? 3 years, 2 years, 1 year. This money won't be reinvested because you need the money after 5 years, you're getting the money after 5 years. So if it's a long-term project and the market it goes up, it means that all these installments you are able to invest for a longer period of time at a higher rate of interest. So the market it goes up from 10% to 11%, you'll be able to reinvest it at a higher rate of interest. But for short-term investor, it's like it's a 1-year project with some money coming in the half year and another money coming at the end of 1 year. So this person only bothers about reinvesting this 50 rupees for another 6 months. उसमें क्या ही तो फर्क पड़ेगा, like even if the rate of interest goes up or down, doesn't matter much. So the long-term investor matters a lot more for the long-term investor, matters limited to the short-term investor. What matters more to the short-term investor is the capital gain part. And that's irrelevant for the long-term investor. So if you want, I can do this thing, short-term investor versus a long-term investor. The two components, coupon rate तो भूल जाओ, दोनों को सेम ही मिलेगा. One is reinvestment income, दूसरा है capital gain or capital loss. So for the short-term investor, what matters more is this is more important, this is less important. For the long-term investor, reinvestment income is more important and this is less important. Now the thing is, both of them are indirectly proportional to the market rate. As in, if market rate is high, the reinvestment income will be more and there will be a capital loss. If the market rate is low, the reinvestment income will be less, but there will be a gain here. So what we are saying is if the market rate is higher, there will be a benefit on the reinvestment income, but there will be a capital loss. But what matters more to the long-term investor is reinvestment income. So when the reinvestment income is more, this loss, the long-term investor doesn't care about. The long-term investor benefits from the higher market rate. Let me put it this way for you to take notes. It will be easier for you. So see, reinvestment income more, and when the market rate is higher, reinvestment income is more. And what matters more to the long-term investor is reinvestment income. So higher the market rate, better it is for the long-term investor. Lower the market rate, it's bad for the long-term investor. But when you see here, when the market rate is low, there is a higher capital gain. And higher capital gain is important for the short-term investor. So lower the market rate, better it is for the short-term investor because the capital gain will be more. So these two tables say the exact same thing what we have discussed above.
But in this case, reinvestment will be done in same bond or in the market.
अंश तुम्हारा आवाज सही नहीं आ रहा है. You have to be a bit louder.
Sir, in this case, reinvestment done in the same bond or in any other.
नहीं तो we don't care about. वही है, मतलब you are going into the market and seeing कि यार कहाँ पे पैसा डाल सकते हैं with a similar risk. So when you go and put money market in a new bond with a similar risk, what you'll get is the market rate. Fair enough? Okay. So guys, it all comes to the investment horizon. A bond investor's horizon yield is the compound annual return earned from the bond over the investment horizon. So if your investment horizon is short versus your investment horizon being long, the returns what you're going to generate from the bond could be different. If the market rate, sorry about that, if the market rate has changed. So if the market has gone up, the returns for the long-term investors will also go up. If the market rates have gone down, the returns for the long-term investor will also go down. So guys, they have discussed all these 5 cases. When the YTM is unchanged and the bond is held till maturity, you get what the market rate is. Unchanged YTM, the bond is sold before maturity, you get what the market rate is. There's no difference. So whether you're a short-term investor or long-term investor, it doesn't matter. Everybody will get the same returns if the market rate remains unchanged. But if there's a change in YTM, if the bond is held till maturity, higher the market rate, higher the returns. Lower the market rate, lower the returns. But if you're a short-term investor, it's ulta. Lower the market rate, better the returns. Because in this case, the capital gain or the capital loss will become more relevant for you. So guys, they're just talking about the price risk, which is the capital gain and the capital loss part, and the reinvestment risk, which we already discussed about. So it's a trade-off between the price risk and the reinvestment risk. For the short-term investor, what matters more is the price risk. And for the long-term investor, what matters more is the reinvestment risk. And to summarize, short-term investment horizon, price risk is more important. And for the long-term investment horizon, the reinvestment risk is more important. So the question to be asked is there an investment horizon where price risk and reinvestment risk are in balance? Yes, there could be a point of time. That person we can call as a medium-term investor. And for that medium-term investor, the price risk is exactly equal to the reinvestment risk. And this person will say, I don't give a damn about what happens to the market rate. because my returns will remain unchanged. That will be more than 1 year, because that investor has to be a long-term investor, then it has to be a longer than 1 year investor, but it has to be shorter than 10 years. That'll be 4 year, 5 years, 6 years, we don't know it. But this is what we call as maculae duration. Maculae duration would mean that average time until the receipt of the cash flow of the bond, like in such a case, in such a way that the loss from the price risk is equal to the profit from the reinvestment risk, or vice versa. So this duration is what we call as maculae duration. We will calculate how to identify maculae duration. But remember, guys, this is a very important concept. If you hold the bond till maculae duration, which could be 4 years, 5 years, or 6 years, the money you lose on one side will be equal to the money you gain on the other side. So you're indifferent with the change in the market rate. If you hold longer than the maculae duration, you benefit when the market rate is more. But if you hold it for lesser than the maculae duration, it's inversely related. Lower the market rate, better it is. So that's the cutoff. उसके पहले short term investor हो, उसके बाद अगर invest कर रहे हो तो you're a long term investor. We will calculate what is maculae duration, but guys, I'll stop here for a few seconds. Do you understand maculae duration as a concept? The calculation part we are yet to do. Guys, another reminder, please switch on your cameras. I just see Ansh with his camera on. I won't pester you if you keep it on. That's like the best way. Are you all set? Should we discuss how to calculate maculae duration now?
Yes, Ansh.
So can we say that Macaulay's duration is used by investors to check before they invest?
The way I would say is like, see, you don't, everybody will, let's say if you're expecting that the market is going to go up, right? So the short-term investor will buy the bonds when they think that the markets are going to go down, and the long-term investors will buy the bond when they think that the markets are going to go up. Is how
Okay.
I'll put it. Okay, how to calculate maculae duration? Let's say there's a bond, and in this case, we are taking the bond to be 5 years. Let's say the coupon rate is 11%. The market rate is, let's say, 15%, right? So obviously the bond will be trading at a discount. Let's say the face value is 100. The market value, I'm sure, will be trading at a discount, right? So in this case, if I assume it's an annual coupon, 1, 2, 3, 4, 5. Here in the first year, I'll get 11% of 100. Oh, sorry. 100 into 11%. In the first year, I'll get 11. Second year, I'll get 11, 11, 11. And in the fifth year, I'll get this 11 plus 100 rupees. This is what I'm going to get, right? The discount rate is 15%. So the present value of this 11 will be equal to 11 divided by 1 plus 15%, to the power of 1 will be discounted for 1 year. This will be discounted for 2 years, 3 years, 4 years, and 5 years. So the total present market value, we know that it will be at a discount, right? And how much discount it should be? You're losing out 4% every year for the next 5 years. The total discount should be 20 rupees, but it won't be 20 rupees. You have to take the present value, right? So if you lose out 4 rupees every year for the next 5 years, the present value will be equal to around 13 rupees 41 paisa. So guys, the discount should be 13 rupees 41 paisa. See, 86.59. What is the discount? 13 rupees 41 paisa. So in this case, what we are saying is you have to get total 86 rupees 59 paisa from the bond for the next 5 years. How you're getting? Some money is coming in the first year, some money is coming in the second year, third year, fourth year, and fifth year. But in this case, the majority of the money is coming in the fifth year. So I want to see that on an average, how many years does it take for you to get your money back? So let's say if I give you money in the 5 installments over the next 5 years, and if I ask you how many years did I take to give you the money back? To give you the total money back, I took 5 years. But I've given you some money in the first year as well. I've given some money at the end of fifth year. So if you take an average, it took you almost 2.5 years to get my money back. If I give you an equal installment for the next 5 years, but in this case, there's a big installment going in the fifth year. So do you think the average here will be 2 years, 3 years, or 4 years? Make a guess. Will it be closer to 2 or will it be closer to 4?
4.
Yes, because a lump sum payment is coming in the fifth year. So how do we calculate that? We will say that, okay, you're getting 9 rupees 57 paisa in the first year, which is equal to how much of the total money? So that is equal to 11% of the total money. You're getting 8 rupees 32 paisa, which is 10% of the total money, 8%, 7%, and 64%. If you add up all the numbers to state the obvious, it will be equal to 100%. So I'm saying that you're getting your 100% money, but some money is coming in the 1 year, second year, third year, fourth year, but a significant amount of money is coming in the fifth year. So the question is, on an average, it took you how many years to get your money back? 11% money came in 1 year, 10% money came in 2 years, 8% money came in 3 years. For 7% of the money, it took 4 years. And for 64% of the money, it took 5 years. So on an average, it took me 4.03 years to get my money back. And this 4.03 is nothing but macro duration. So if you hold the bond beyond 4.03 years, higher the market rate, better it is for you. If you hold the bond for less than 4.03 years, let's say 3 years, 2 years, higher the market rate, bad it is for you.
So then the Macaulay duration will always be near to the maturity because the bigger payment comes the last
Okay.
year.
Okay, let's change the market rate. But let's say if the coupon rate is 20%, it'll be less than 4. But if I make a coupon rate of, let's say, 2%, it'll be almost equal to 5.
Okay.
And for a zero coupon rate, zero coupon bond, it'll be 5.
Right.
And try to understand, guys, what for 0% macro duration being 5, it means that is there any reinvestment income in case of a zero coupon bond? No. So only thing what matters to you is if the market is more, you'll be selling the bond at a discount. Because reinvestment income to kuch hai hi nahi uske andar. So if you hold the bond beyond 5 years, can you hold the beyond 5 years? No, the maturity is 5 years. So if you hold the bond before 5 years, you'll benefit. If you hold the bond for 5 years, you're indifferent, and there's no possibility of holding the bond beyond 5 years in this case. So if you're expecting the market it to go up, don't buy a zero coupon bond. Okay, if you're expecting the markets to go up, the benefit you get because of the markets going up is that you are able to reinvest the coupon at a higher rate of interest. That won't be applicable for you in this case.
Ansh, this is kind of similar type of calculation to the discounted payback period, right?
Oh, the payback period as a concept has been removed from your main syllabus, so I don't want to talk about it. But हाँ, मतलब discounted payback period है, but what's different here? There's nothing different. You're right, absolutely right. I don't know what is discounted payback period. Okay, just
The payback, like it's nothing, just taking into consideration the discounting factor also.
very good. Yeah, that's like a very good thing you said. It's a discounted payback period technically. How many years does? But उसके अंदर discounted payback period में we are just concerned about how much time does it take for you to get your initial money back.
Yes, yes.
यहाँ पे like there's no initial money. The total money, how many years does it take to get it back? That's the difference. Okay, guys. So the interpretation of the macro duration is that if we have an investment horizon of 4 years, then we still earn the original YTM of the bond, irrespective of the market going up or going down. If you're a short-term investor versus a long-term investor, in that case, there's a duration gap, and then you'll benefit or lose depending on whether you're holding it for less than 4 years or more than 4 years. Great. So that was the very important topic in the sense that people just read through it and they just remember it. But I wanted to make you understand like why it's happening. Let's go to the next topic. The yield-based bond duration, measures, and properties. And let me just confirm. I think we did confirm it in the last class. Convexity करके topic है क्या? ठीक है. So what we'll do is we'll take a quick break, and after the break, we'll discuss this duration in a lot more detail, and we'll bring up the convexity as a concept. We discussed about convexity before, but we'll again bring it up, and we're going to do lots of interesting things on this duration and convexity, which will cover both the topics. We'll take a very big comprehensive example and cover everything in one shot. Okay? The reason I'm doing it as a comprehensive example, like one thing is it's going to be a bit lengthy example, but because you do it comprehensive, जितने भी concepts है ना, like everything will be like bounded together. It will give you a very very holistic perspective कि कर क्या रहे हैं इस topic के अंदर. ठीक है? So we'll be doing like almost 6, 7, 8 calculations, but as a single example. So guys, be ready. Have a strong cup of coffee. I need 100% of you in the class after the break. Okay? So it's 10:15. We'll be back at 10:35 and then continue. Okay, guys, so let's get started on duration and convexity. Before we get started, what do you think convexity means? Sorry, what do you think duration means? Is duration the number of years you're holding the bond? What is duration?
Holding the bond.
Okay. Remember, like in one of the classes, I told you duration has nothing to do with number of years.
Yes.
Is not the time period. What is duration? Anyone?
Number of years someone is invested in the asset.
Okay, so let's do this. Okay, let's take the coupon rate as 10%, market it as 10%, face value is 100. The market value will obviously be 100. And in that case, I'm getting a macro duration of 4.17 years. What this 4.17 means is a very important point. In a very layman terms, we can say that, okay, this 4.17 is the number of years it will take for you to get your money back. Right? Some money will be coming in the first year, some money will come in the second year, but the majority of the money will be coming in the fifth year. So on an average, it took you 4.17 years to get your money back. But we say that duration is nothing but what is the change in the market value with the change in market rate. Remember, we did it in one of the previous classes. Did we or did we not? So we said that, okay, if the market rate goes down to 9%, the value of the bond goes up to 3.89. It means if the market rate changes by 1%, the value of the bond goes up by 3.89%. So the duration here is equal to this divided by this, which is equal to 3.89. But we said, hey, everyone knows that the duration will be negative. So we do not say minus 3.89, we simply say 3.89. What does it mean? That if the market rate changes by 1%, you will lose the money for 3.89 years. And if the market rate goes up by 1%, which is 11%, the value of the bond will go down. So in this case, if the value goes up by 1%, the market rate goes up by 1%, the value goes down by 3.7%. So in this case, the duration is 3.7. So what we said, if you remember, is that, hey, if the market rate is going down, it's good for the short-term investor that the value is going up. And the benefit is a lot more compared to the loss. The loss is only 3.7, but the benefit is 3.89. And this is what we said is nothing but, what is this called? When your profits are more and the losses are less?
Convexity.
The convexity. So we are saying if I draw the chart, if I take market rate here, and if I take market value here, we are saying that if the market rate increases, the value will fall, but the fall will be flatter. And if the market rate decreases, the value will increase, but the increase will be steeper. So this entire curve is a convex curve because it has its back towards the origin. Now, what is duration? Duration has nothing to do with time period. Duration is nothing but what is the change in the market value with the change in the market rate. But guys, there's a very close relationship, right? There's a formula which we'll do in a bit. But if my macular duration is 4.17, and if you divide the macular duration by 1 plus R, you get the effective duration, which we'll discuss about it in some time. What is R here is 10%. So you see 3.79. So there's a formula that if my macro duration is 4.17, it means it's taking you 4.17 years to get your money back. I'm discounting it by just 1 year. I'm dividing it by 1 plus R. So this is what we call as effective duration. What is the effective duration? That if you invest in a bond, if the market rate changes by 1%, you are going to lose or you are going to gain by 3.79%. But the problem is that is the losses are same as the gains? No. If you go from here to here, the duration will be less. What do I mean by duration being lower? It means the impact on the value of the bond for 1% change in market rate will be lower compared to the increase when you go from here to here. So let's try using my drawing skills if I'm able to accomplish it. But let's see if oh wow. If I take market rate here, if I take market value here, if the market rate is 10%, the market value is 100. If the market value goes up to 11%, the value falls, but the fall is flatter. But when the market rate decreases, the increase is more. This is what we are talking about, right? So let's say the starting point is this red line. At this red line, the market rate is 10%, the market value is 100. Let's say if the market rate goes up, which is the green point, if the market rate goes up to 11%, yes, the value of the bond falls. The value of the bond falls by 5 rupees. But if the market rate decreases, and let's assume that's a pink line, the value of the bond goes up, but the increase is a lot higher. See, the decrease is only this much, but the increase is a lot more. I've exaggerated the impact, guys, but generally the impact nahi hota hai, but there will be difference. The difference we are getting is 3.89% versus 3.7%. This is 3.89, this is 3.7. So duration is nothing but what is the change in the market value with the change in the market rate. It's an inverse relationship, but we do not say the negative number. We simply say it's 3.89 versus 3.7. And the duration is more when the market rate comes down. The duration is less when the market rate goes up. And duration is nothing but the slope of the curve. What is duration? The change in the y-axis with the change in the x-axis. What is the slope? Change in the y-axis with the change in the x-axis. So guys, slope of this curve is nothing but duration. Given it's a negative in a sloping curve, the relationship between the market rate and the market value is negative. It means higher the market rate, lower the market value. Lower the market rate, higher the market value.
So,
Yep.
You said that duration will be more if the interest rate come down. Here you can
Yes.
I can see the pink line is have a greater gap and green line is lesser gap.
Yeah,
Even
exactly.
though only let's say your red line is at 8% and
Okay.
your green line is 10% and our pink line is 6%, sir.
Yep,
So the
makes sense.
basis point difference is 2%. Even though for the below and greater basis point is 2%, so that pink line will be more duration, sir. So
Yeah,
same.
exactly. So in this case, whether you go from red to green or red to pink,
Okay.
on the x-axis, the difference is 2%.
Okay.
But on the y-axis, from red to green, the decline is lesser, but the increase is much more. It means when you come from red to pink, the impact on the value of the bond is a lot more. But when you go from red to green, the impact on the value of the bond is limited. So lower the market rate, higher the duration, Higher the market rate, lower the duration.
Sir, is it possible to elaborate through an example, sir? If
We'll
time
do lots of
permits.
examples. What example? Sorry, say it again.
For this one, sir, it's a little bit I'm struggling, sir. Here.
Okay, so let's try another way. Let's do it mathematically.
Yeah, sir, in simple form, duration form.
So here, abhi, I'm getting a macular duration of 4.17, and there's a way to calculate effective duration. I'll come to a calculation in a bit more, but just remember this formula that whatever is the macular duration, if you divide it by 1 plus r, you get the effective duration. Is it clear that the duration will be more on the left side and the duration will be less on the right side of the curve?
Yes.
Okay.
So, what is major difference between effective and Machiavelli, sir?
Nothing. It's just like different way of calculating duration, but our entire focus will be on 3.79, which is the effective duration.
Okay.
Now,
And once we calculated Machiavelli, then only we go for the effective.
yeah, that's one way to calculate effective duration. There's another way to calculate effective duration, which I'm going to tell you now. So in this case, guys, what do you think? Did you know about duration and convexity before you came for this class?
Yes, sir.
You knew about it,
Yes, sir.
or before your CFA syllabus,
Yes, sir.
or you know it from your 10th and 12th.
No, no, sir. That no. I did FRM in that syllabus. I know.
Huh.
Yes,
So what I'm trying to make a point here is, let's say there's an investor who has not done his CFA, has not done her FRM, has not done her CFA, sorry, MBA in finance. Nobody said, right, that you need a degree to be an investor. It's easy for the investor to understand dividend कहाँ से आता है, share price क्या होता है, interest rate क्या होता है. But think about you trying to explain to the investor कि अरे यार there's something called duration. Oh, duration समझ में आ गया. But if you go on this side, the duration is lower. If you go on that side, duration is higher. Investor will say, hey, dude, I've got money, but I don't have time for these things. And even if I have time, I don't want to get into this. So the problem is, if an investor asks you, hey, dude, what will be the impact on the value of the bond with the change in the market rate, which is nothing but duration? What do you tell him? Do you tell him 3.89 or do you tell him 3.7? Acha, it depends. The minute you say it depends, the investor will get even more frustrated. Dude, just keep it simple. Just tell me one number. What is the one number you tell?
3.89.
Why not 3.7?
Because 3.89 is larger impact on particular.
But 3.7 is smaller. मतलब, so see, in this case, what you'll do is, तुम दोनों का average बताओगे.
Okay.
And this average is nothing but this. Both are similar.
So basically, effective is the increase and decrease of the average of the increase and decrease duration.
Exactly. Sorry, guys, I didn't take like the exact numbers. That's why there's a gap. Otherwise, it should be exactly 3.79. I can try doing it. Let's say if it's 9%, it's equal to this minus, sorry, is equal to 100 minus this. And the answer will be, and if it becomes 11%, the value will become 3.7. So I'll replace this 3.7 with the exact number. And what I'm getting here is 3.79. And what I was getting here is 3.79. I really wishful that, both of them will be exactly, sorry guys, there's a small gap. I don't know why there's a small gap, but ideally both of them should be exactly the same. Okay. So macular duration divided by 1 plus R gives you the effective duration, which is nothing but the average of what will be the duration when there's a decrease in the market rate versus what will be the duration when there's an increase in the market rate. You cannot go and tell the investor two different things. You cannot introduce the concept of duration. So simply tell the average of both. And if you understood this part, think of a real world scenario. Again, I'm taking market rate here. I'm taking market value here. And let's say this is the curve. So actually what will happen is the black line is a real world in the sense that if the market rate goes up, and let's put a starting point and the like the original point. Let's say this is the original point where the market rate is 10% and the market value of the bond is 100 rupees. Now, originally what will happen is when the market rate goes up, the value of the bond falls, but the fall is flatter. When the market rate goes down, the value will go up, but the increase is steeper. But did you introduce the concept of convexity and the change in duration with the change in market rate to the investor? No. What you told investor is, hey, the duration is equal to 3.79. So the way investor will understand is that he'll understand the brown line. The brown line looks like this. So according to investor, when the market rate goes up, the value will fall by how much? 3.79%. And if the market rate comes down, the value will go up, but by how much? 3.79%. But actually what's happening is the value falling by 3.79%? No, the value is falling only by 3.7%. So the reality, which is the black line, is above what you told the investor, which is the brown line. And in case of an increase, is the increase 3.79? No, the actual increase is 3.89. So because you told 3.79 to the investor, the actual increase will be more than 3.89. See the black curve compared to the brown line. And the decline will be lesser than 3.79. Again, see the black curve compared to the brown line. So investor will be thinking that the value of the bond has fallen so much, but it has not declined that much. The investor will think that the value has gone up this much, but the actual value has gone up a lot more. So what will happen, guys? An investor will simply not bothered about the value of the bond. You'll say, yaar, why is he interested about the interest? Look at the value of the bond. No, it's easy. But the problem here is that the investor has invested into hundreds of the bonds. And some of these bonds may not be even trading in the market. So this investor will simply look at what is happening in the market rate in general. So if the repo rate has gone up, if the market rate has gone up, if something else has happened in the economy, and he knows that, okay, overall the value, or sorry, overall the market rate has gone up by 20 basis point, which is 0.2%. And all the bonds he's holding, the duration is 4x. It means that he has lost 0.2% into 4, which is 0.8% on his entire portfolio of bonds. This is the math the investor will be doing. And in our example, it's not 4. In our example, 3.79. But is he losing 3.79 times? No. Actual loss for him is only 3.7 times. So you would think that his portfolio has gone down by 0.76, but his portfolio has gone down only by 0.74. And in case of an increase, he will think that his portfolio has gone up by how much? 0.76, but actually his portfolio has gone up by point. What? Change in your kuch. It's a very small. So he thinks that his portfolio will go up by 0.759, but his portfolio has actually gone up by 0.778. So he will think that he's always on the brown line, but the reality is that he's always on the black line. So guys, will he be positively surprised or will she be negatively surprised when looking at the reality compared to what the belief is? Okay, let me stop here for a few seconds. I see lots of blank faces. May I request all of you to please switch on your cameras? Thank you, Ria, Himachali, and Ansh to keep it on. Waiting for others. Anushka, I've never seen you, so please can you switch on your camera and keep it on? Nandini, seeing very less of you today. Okay, how easy or how difficult it is in terms of logic? We are going to do lots of work around it, but it covers like 2 or 3 chapters in together with this big example I'm doing. So this lays down the foundation of what we're going to do next. Is it logical? What you can tell investors? Why you can't tell the entire story to the investors? It'll be too technical, too tricky. And what you're telling investor would mean that the value will go down on the brown line and value will go up on the brown line. But the reality is that you're going as per the black curve. And the black curve is always above the brown line. So the investor will always be positively surprised under all the scenarios. Why the investor will be positively surprised? Because she will think that the value will go down by 3.79%, but the value will go down only by 3.7%. The investor will think that the value will go up by 3.79%, but the actual value will go up by 3.89%. So in either case, there will be a positive surprise to the investor. Now, guys, tell me one thing. In case of the US, you would have heard about the news flow, right? The interest rates are very, very high. And is it a small thing or is it like a big thing everybody's talking about? It's a huge thing, right? Once in a lifetime thing. Okay, the interest rates are too high. How high it is, by the way?
About 5.5.
Sorry.
Sir, 5.5%.
हाँ 5% तो मतलब ठीक है रिटेल के अंदर है बट इफ यू लुक एट द SOFR like the actual risk free overnight rates they're like close to 4% के आसपास and what is the generally कितना रहता है इंटरेस्ट रेट वहां पे 2% 2% becoming 4% become a huge thing and people are like oh my god what will happen it's 4% it's too high. So what I'm saying is what we are assuming in all the cases is the market rate will change by 1%. It'll go from 10% to 11%. It'll go from 10% to 9%. Unless you're in an economy like, which is a very, very small economy, the market it doesn't change like this, right? So we are expecting in case of India that the interest rates will go down quite significantly in the coming years. You know what that significantly means? That अभी जो 6.5% repo rate will become 6% in the next couple of years. So as a result, the actual change in market rate will not be 1 percentage point. It'll be 0.01%. It'll be 0.02% on a daily basis. And if you look at over a period of time, the impact will be like 0.1% in a year, 0.2% in a year. And that too in a country like India. In case of the US, for the entire year, it will be plus minus 0.05%. So what I'm trying to say here is that if you assume that the current market rate of 10% becomes 11%, see the gap between the black curve and the brown line. It's quite significant. But I'm saying that if 10% becomes 10.1%, can you see the gap between the brown line and the black curve? It's very, very tiny. It'll be a rounding off mistake. So as a result, that's second thing, you don't bother about getting into those nitty-gritties with the investor, that for a 0.01% change, 0.02% change, technically the black curve and the brown line are one and the same thing. Only when the impact is bigger that they try to widen, the gap starts widening up. But in the classroom, we'll assume that plus minus 1% change in the market rate for you to understand the concept. But in real world, that doesn't happen. So Bangladesh, Sri Lanka, they were going through a big financial crisis. They were changing the market rate by 1 percentage point. But they're very small economies, huge financial crisis. And still people said, oh, yeah, 1% is too much, even for those economies. Okay? So guys, duration is nothing but what is the change in the market value of the bond with the change in the market rate. It's directly correlated with macular duration. What is macular duration? For how many years you're investing your money, technically, right? Or how many years does it take to get your money back? And macular duration is the number of years. Effective duration is the change in the market value with the change in market rate. Both of them are related. What is the relationship? Macular duration divided by 1 plus R gives you the effective duration. What is the linkage here, guys? Simple funda here is, if you're investing money for a longer period of time in a bond which is 10-year bond, if the market rate goes down by 1%, let's say, the value of the bond will go up a lot more because you're still getting 10% when the market rate is 9%, you're getting that 1% more for next 10 years. Don't you think that the value of the bond will go up more? Yes. So the duration, which is effective duration, which is equal to change in market value divided by change in market rate, has a direct linkage to the macular duration, which is on an average, how many years does it take to get your money back? Because if you invest for a longer period, the impact on the value of the bond will be more with the change in the market rate. Remember, we did this exercise in the very beginning. If it was not a 5-year bond, if it was a 10-year bond, that 1% change will impact the value of the bond a lot more. Why? Because you're going to get stuck with that bond for next 10 years rather than just 5 years. I'll do that exercise again, but this will tell you that longer the maturity of the bond, higher will be the macular duration and higher will be the effective duration. So maturity of the bond, macular duration, and the effective duration, these all three are interrelated. And why they're interrelated? The logic being that rather than 2 year, if you invest in a 10-year bond, is the maturity longer? Yes. What is macular duration? On an average, how many years does it take to get your money back? Will that be longer? Yes. And what is effective duration? The change in the market value of the bond with the change in market rate. If the market rate goes down by 1% or goes up by 1%, you're going to benefit or lose that 1% for next 10 years. Don't you think effective duration will be more as well? Yes. So guys, for me, longer the maturity, higher the macular duration, and higher is the effective duration. But those three things mean three different things. Maturity means what is the life of the life of the bond. Macular duration means that how many years will it take on an average to get your money back. And the effective duration means the change in the market value divided by the change in the market rate. I'll stop here. Ask me questions. If you want, I'll repeat all of it, some of it. If you don't tell me, I won't know. Let's do a quick survey on a scale of 1 to 10, how easy you are finding it versus how difficult you're finding it. 1 being very easy, 10 being very difficult.
Okay. 5 is
अंश थोड़ा माइक के पास बोलो यार, तुम्हारा आवाज बहुत दूर से आ रहा है मेरे को.
Sir, why we
I got response only from 6 of you. Can others please respond as well?
sir, why is this found that effective duration only for 1 year, not for 5?
अच्छा, ये इफेक्टिव, ये फॉर्मूला ही है. इट्स नॉट लाइक 1 ईयर के लिए कर रहा हूँ. द फॉर्मूला इज लाइक दिस: मैक्लो ड्यूरेशन डिवाइडेड बाय 1 प्लस इंटरेस्ट रेट. It's not about 1 year or 5 years. That's the formula. There's a derivation of it, guys, but it'll become too complicated, so I don't want to get into it. But the reason I'm doing it is because this 3.79 and this 3.79 are very close. It tells you that macro duration and effective duration are interrelated. Let's say मैं एक काम करता हूँ. I'll just extend the same example but make it 10 years. ठीक है? Let's do that. Okay. And the market value will be nothing but the present value of everything. So you're getting 9% in the first year, 8% in the second year. If I do it across, you're getting a lump sum amount at the end of 10th year. But guys, given the 10th year payment is coming after 10 years, the weightage of that is only 40%. And if I sum all of it, this is equal to my 100% of the payment, right? But on an average, how many years is it taking to get my money back? 6% of my money will come in 6 years. 5% of my money will come in 7 years. 5% of my money will come in 8 years. 4% of my money will come in 9 years. 42% of my money will come in 10 years. So you increase the maturity from 5 years to 10 years. My macro duration, which was 4.19, becomes 6.76. As a result, based on this, if I calculate the effective duration, it'll be close to 6.14. But if I try to calculate the duration using the mathematical thing, if the market rate goes up to 11%, the value goes down to 94.11. So the decrease is 5.89. And if I decrease the market rate to 9%, the value goes up by 6.42. So the increase is 6.42, the decrease is 5.89, and the effective duration I'm getting this way is equal to, sorry, I should get it back to 10%, is equal to 6.15. So see, this 6.15 and this 6.14 are similar. And what happened? Because I increased the maturity, the macro duration went up, the effective duration went up. Why the macro duration went up? Because now it's taking you a bit longer to get your money back. Why the effective duration went up? Because now when 10% becomes 9%, you still get a coupon rate of 10%, which is 1% more. Not for 5 years, you get it for next 10 years. So the value of the bond increases more when the market rate goes down in case of a 10-year maturity versus a 5-year maturity. And what I told you, remember that generally the market rate won't change by 1 percentage point. So what I'm going to do here is I'm going to change the market rate only by 0.1%. ठीक है? तो अभी 10% की जगह if I do it 9.9%. See, the value of the bond goes up by 0.62, which makes sense. Why? Because I know that for every 1% the impact will be 6.15 times. But am I changing it by 0.1%? No, I'm changing it only by 0.1%. So the impact on the value of the bond will be how much? 0.0062. Given the value of the bond is 100, the impact will be equal to 0.6153. But यहाँ पे impact कितना हो रहा है? 0.6171 हो रहा है. Oh, there's a gap of 0.0018. क्यों? Because with the decrease in the market rate, the value of the bond goes up a lot more in this case. But the gap is only just 0.0018, which is very, very small. So we'll do lots of calculations, guys, lots of things. And the four important things which we want to do. One is calculate duration. We already did it, but I'll give you some fancy formulas to complicate what we already done in a very simple manner. But I still have to give you a formula because that's part of your syllabus. But once I give you the formula, you should be like, अरे यार ये formula की जरूरत ही नहीं है. That's what I want you to do. But you should not be like, अरे ये formula discuss ही नहीं किया या ये formula आ गया exam में उसका application आ गया. What will you do? But technically, we discuss the formula without discussing the formula. You'll realize that in some time. The second part is apply duration. The third thing is calculate convexity. And the fourth thing is apply convexity. So these are the four things we are going to do. Let's call it A, B, C, D. And this is going to take like almost an hour, if not more. And we'll do like one question from my side and then you'll practice one from your end. And this will cover almost 2 chapters, guys. Okay, so let's start. Let's take an example, or let's take a starting point that the face value of a bond is 100. The coupon rate is 8%. The market rate is also 8%. As a result, the market value of the bond is 100. Let's say I'm taking two scenarios, case 1 and case 2. Let's say it's given in the question that if the coupon rate changes to 9%, yeah, that's a bad case. Coupon rate cannot change, it will remain fixed. But let's say the market rate goes up to 9%. What will happen to the market value of the bond? Will go down. Let's say it goes down to 95 rupees. And the second case is, why am I even writing it? They won't change. Let's say if the market rate goes down, what do you think will happen to the market value of the bond? It'll go up. Now I give you three options. Will it go up to 105? Will it go up to 104? Or will it go up to 106? What seems more likely?
106.
Why?
When it goes up, it's more.
Yes. Given the convexity, the increase will be more than the decrease. If the decrease is 5 rupees, the increase has to be more than 5 rupees. So here the increase will be 106. So it will become 106 in this case. I don't know whether it will be 106 or 105.5 or 107, but I'm pretty sure it has to be more than 5 rupees. Okay. Now in this case, what is effective duration? So to calculate the effective duration, I'll calculate the duration with a decrease in market rate. So if the market rate decreases, what is the duration? So when the market rate decreases, what is the change in the market value? The market value goes down by, sorry, goes up by 6%. That's correct. 100 becomes 106. So it's an increase of 6%. What was the initial starting point? The market rate goes down by 1%. So for a 1% decrease in market rate, the value of the bond goes up by 6%. So the duration is minus 6. We know it's going to be minus, so let's not bother about it. Let's call it 6. If I do the same thing for a duration with an increase in market rate, the market rate goes down by 5% with an increase in market rate of 1%. I know it's negative number, but we don't bother about it. We simply say the duration is 5. What are you going to go and tell the investor? 5 or 6?
The average of it.
Yes. So in this case, the effective duration is equal to average of 6 and 5, and that's equal to 5.5. So that's your first step A, which is calculate duration, and my duration is equal to 5.5. Guys, I've not used any formula here. Complete common sense we have applied. But let me tell you the formula, what has been used in your books now. You should be using this formula, by the way. So the duration here should be equal to, how do you read this formula first of all? What is the value of the bond with a decrease in market rate minus the value of the bond with an increase in market rate divided by 2 times the value of the bond with no change in market rate and the current market rate. Let's do that. What is the value with a decrease in market rate? It's 106 minus what is the value with an increase in market rate? 95. So my numerator is 106 minus 95. And in the denominator, I'll take 2 times the initial value of the bond, which is 100, times the market rate, which is equal to 8%. So guys, or change in market rate, sorry. How much am I changing the market rate by? In each instance, 1%. So guys, if I do 11 divided by 2, I get 5.5. But this is using the formula. What I did was just using the logic. In both the cases, you'll get the exact same answer. I'll go to step B now, which is about applying duration. How do you apply duration? Let's say you are an investor and I tell you that, hey, the duration is equal to 5.5. So you had bought the bond. This is the bond you had bought. And if I tell you, if you buy this bond, the duration is 5.5. So in this case, you see that the market rate has gone down to 7%. What is the change in the market rate? 1%. You will think that the impact on the value of the bond will be how much? If the duration is 5.5 and if the market has gone down by 1%, what do you think will happen to the value of the bond? Will it go up or come down? Go up.
Ansh, sorry, like, can you please show the duration calculation once more using the formula?
Using the formula, okay, sure. So I'm saying, what is the value of the bond with a decrease in market rate?
Hmm.
So in the market rate comes down from 8% to 7%, the value of the bond goes up to 106. Minus, what is the value of the bond with an increase in market rate? So in the market, it goes up from 8% to 9%. The value of the bond goes down to 95 rupees. So all I'm doing in the numerator is 106 minus 95. And in the denominator, I'm taking 2 times the initial value of the bond multiply by how much you're changing the market rate by. So changing the market rate by 1% in both the instances. So I'm taking 2 into 100 into 1%. So I'm getting 5.5, which is exactly the same as what we got using the logical calculation without any formula. Does it answer your question?
Yes, Ansh.
The second part is how to apply duration. So if I tell the investor that, hey, for this particular bond, the duration is 5.5, and if the market rate goes down by 1%, I know that the value of the bond will go up. What do you think the value of the bond will go up by? Don't look at this side. Just if I tell you that the duration is 5.5 and the market rate has gone down by 1%, what do you think will be the increase in the value of the bond?
It should be more than 5.
No, no, no. You don't know the convexity concept, Rishabh.
Okay.
So be in the split personality. So
5.5.
left wala part is the what we know as a CFA student. But now I want you to step in an investor's shoes. What the investor knows is duration is 5.5.
So it will go by
Should
5.5
increase
only.
by at least 5.5%.
What is at least? 5.5. Investor doesn't know the convexity part. Investor doesn't know that it's an average of 6 and 5. You're getting my point? So investor will think that, okay, it's going to be 105.5. Why 105.5? In this case, if the market rate changes by 1%, the impact on the value of the bond will be 5.5 times 1%, which is equal to 5.5% times the initial value of the bond. So the total impact will be 5.5. So 100 will become 105.5. If the market rate goes up to 9%, what will be the value of the bond?
95 point.
Your logic is
Sorry,
correct, but your math is wrong.
sorry. 94.5.
Yeah, 94.5. Again, the same thing. So we are telling the investor, hey, dude, whatever happens to the market rate, the impact on the value of the bond will be 5.5% times more. So the market rate changes by 1%, the impact on the value of the bond will be 5.5%. So 100 will become 105.5 if the market rate goes down, and 100 will become 94.5 if the market rate goes up. Because to the investor, we never talked about the convexity concept. So according to her or him, the increase as well as the decrease will be equal to the duration of 5.5. So that brings us to the second part, which is apply convexity. How do you apply convexity? You simply take what is the, sorry, how to apply duration. You simply take what is the duration, what you calculated in step A, multiply by what is the change in the market rate, multiply by the initial value of the bond. And the impact of the duration is equal to 5.5. It means the value will go up by 5.5 and the value will go down by 5.5. So I can give you a formula for this, how to apply duration. It'll be somewhere, guys, in your book. Let's not bother about it. But in somewhere in the books, the formula would be the duration multiplied by YTM, change in YTM multiplied by the value of the bond. So it'll be equal to V0 into change in YTM into duration. That will be the formula. But this is nothing but step B. So we know that the duration is 5.5. In this case, the impact of the duration is also 5.5. Luckily, why? Because the value of the bond is 100 and the market rate is changing by 1%. So 100 times 1% times 5.5 is equal to 5.5. Luckily, they may not be same. Let's say if the value of the bond was 1000, this number would have been 55. Understood? And if you want, guys, we can do that. Let's assume that the value of the bond is 1000. And in real life, it goes to 950. I'm just adding 10 everywhere. Why this will become 1055? Because the impact on the value of the bond is equal to 1055. So 1000 plus 55 is 1055. 1000 minus 55 is equal to 945. But this 5.5 will remain 5.5. Why? Because here I would do the formula that if what is the increase in the value of the bond? 6%. So this 6% remains 6%. What is the decrease in the value of the bond? 5%. So this 5% will remain 5%. If I do it with logic, this is 5.5. If I do it using formula, it remains 5.5. So nothing changes in the duration calculation. Sorry, guys. Now the problem here is we know that this is the reality on the left hand side. But what the investor is thinking is on the right hand side. The reality is that the price of the bond has gone down to the reality is that the price of the bond has gone down only to 950. But what is the investor thinking? That the value has gone down to 945. The reality is that the price of the bond has gone up to 1060. But what the investor thinking? That the price of the bond has gone up only to 1055. So investor is underestimating the value of the bond in both the cases. And there's a positive surprise waiting for this investor when this investor know the reality. So guys, remember the chart we drew? Investor is thinking that he's traveling on the brown line, but reality is the black curve. And the black curve is above the brown line at each and every point. And what is the difference between the brown line and the black curve is nothing but the convexity. So that brings us to the third step, which is calculate convexity. Okay. Now, before we do work on the convexity, I need a confirmation from your side. Are you clear with step A and step B? That is calculate duration and apply duration. And if you apply duration, you end up underestimating the value of the bond compared to what the reality is. Because what we are missing here is we have not captured the benefit of convexity. Take your time. I'm in no hurry, but keep talking, guys. Keep letting me know what you want me to repeat if there's anything.
So
Yep.
can we say duration or convexity decide the direction of bond?
Oh, sorry, say it again.
Can we say duration or convexity decides the direction of bond?
Duration of convexity. There are two different things. Duration is a separate thing. Convexity is a different thing. And the duration is always going to be negative. It means with the increase in market rate, the value of the bond has to go down.
Okay.
So in a very, very simple layman term, duration is nothing but the slope of the curve. And the slope of the curve is negative. So duration is always going to be negative. It means that if the market rate goes up, the value will go down. If the market rate goes down, the value will go up. So this is the reality. What the investor has been thinking is about the brown line. So in this example, guys, when the market rate is, when the market rate is 10%, in our example, that's equal to 8%. The value of the bond is 100, no doubt, 1000. When the market value goes to 9%, Investor is thinking that he'll be at 955, but the reality is that it's at 9. Sorry, the investor will think that it'll go down to 945, but the reality is that it's actually at 950. So you see the gap. So this point is 945. But the reality is that it's at 950. When the market it goes down, investor will think that the value has gone up to 1055. But the reality is that the value has gone up to 1060. So this gap of 5 rupees is nothing but the convexity impact. And why the investor is underestimating the value of the bond? Because he or she has not captured the impact of the convexity yet. So this is the third and the fourth step. We are going to calculate what is convexity in this case, how much is the convexity, and we'll apply convexity. And once we do that, the estimate should align with what the reality is. So the gap between this and this number is nothing but the convexity impact. People who are like from engineering background or maths background, duration is the slope, convexity is the slope of slope. If it doesn't make sense to you, just ignore what I just said. Duration is a first derivative, convexity is a second derivative. Duration is the change in the market value with a change in market rate. Convexity is the change in change. What do I mean by that? Let me make it a bit more easy. Let's say if I draw this chart, what do you think is the slope? Is it a positive slope or is it a negative slope? Are you going up or are you going down? Very basic question, guys. Come on, you can answer that. Or too basic to answer, I get it. So it's a negative slope, it's going down.
Yes, down.
But let's try to overanalyze it. The pace at which you're going down. Let's say this part is steeper. So going down like very fast, like you're jumping from an aeroplane. The rate of speed at which you're going down is quite tremendous. Okay? But let's say you hit the atmosphere. Rate of speed will come, the rate of decline will come down. You're still declining, but at a lower pace. You open a parachute, you're still declining, but at a much lower pace. And by the time you hit the ground, you're still coming down, but at a very, very flat pace. You're going down, but at a lower pace, which is good for you. If your pace of decline doesn't come down, you'll hit the ground at a very fast pace, and you know what will happen in that case. In other words, let's take an example of a startup. Let's say the startup is making a loss of 1,000 crore rupees in the first year. Is it a bad thing? Yes. Next year, they make a loss of 500 crore rupees. Is it bad? Yes, but it's less bad than the last year. Third year, they make a loss of 200 crore rupees. Is it bad that they're still making losses? Yes, but it's less bad than the last year. So convexity is a positive thing around duration. It means there's a decline, but the decline is not that steep. But what the investor is thinking is that the decline is similarly steep and the increases are similarly steep. But the reality is that the increases are steeper and the decreases are flatter. So convexity is the change in change, is a slope of slope, is a second derivative, is what we are going to discuss next. As I'm doing it as slow as possible, Okay, so let's do it. If there are no questions, I'll do it logically and then I'll give you a formula. Okay. So the reality is that the actual duration is 6 versus 5 when the market rate goes down versus market rate going up. But what did you tell the investor is 5.5? So actually there's a gap of 0.5 here. There's a gap of 0.5 there. So the way to do this is the actual duration is 6 versus 5, but what you told investor is 5.5. So the gap is how much? 0.5 on either direction between the reality and what you told investor. This is the gap between the brown line and the black curve, right? In reality, it will be going up by 6, but actually it's the investor will be thinking it will be going up by only 5.5. In reality, it will be going down by 5, but the investor will be thinking that it will go down by 5.5. So the convexity is nothing but the difference between what you told the investor and what the reality is. And the formula to calculate convexity, guys, is I'm trying to make it a bit easy for you because the formula may look a bit nasty, but do not get scared when you look at the formula. It's a very easy formula and we are going to try to simplify the formula. The formula is this convexity का formula. What the formula says, the numerator, what is the value of the bond with a decrease in market rate? The value of the bond with a decrease in market rate is 1060 plus what is the value of the bond with an increase in market rate, which is 950 minus 2 times the value of the bond, which is 1000. Guys, this number has to be always positive. Why? Because the increase is more than the decrease. Now, in the denominator, there's no 2 here. The 2 is missing. But ideally, there should be a 2 here. I'll give you the story of 2 after some time. But let's assume that there's a 2 here as well in the denominator. So the actual formula is 2 times blah, blah, blah. But there's no 2 here. I'll give you the story about 2. So if there was a 2 here, and if you divide this by 2, you get 5. And if you divide this 5 by the change in the market rate, how much you're changing the market rate by? 1%? You get 0.05. And guys, this is what I've been telling you. And if you, okay, so let's do it. I'm doing 2, which is there in the denominator, multiply by change in the market rate, which is 1%, multiply by the value of the bond, which is 1000. I'm getting 10 divided by 20. And what is 10 divided by 20? Is nothing but the half I discussed above. The gap of half here, the gap of half here. But they've just put that in a nice complicated formula with the numerator being 10 and the denominator being 20. So there are two things. This is the logic part. In this case, like using the logic, I'm getting 0.5. Using the formula, I'm getting 0.5. But it's not that simple. First of all, in the formula, there's no 2. Why there's no 2? Because we'll be using that 2 when we apply convexity. Okay? And the second point here is that because it's a change in change, because it's a second derivative, because it's a slope of slope, we do not take the change in market rate, we take change in market rate ka whole square. As a result, the convexity is equal to 100. But the way I would make sense of the numerator is that the increase is more than the decrease, and the difference is equal to 10. In the denominator, there should have been a 2 here, but that 2 is absconding. We'll bring that 2 a bit later on. And given it's a second derivative, it's a change in market rate ka whole square with the initial value of the bond. So guys, this is my step C. According to step C, my convexity is equal to 100. And that convexity is always going to be positive because the increase is more than the decrease. Though the slope is negative, but the slope ka decline is getting lower, which is a positive thing. I gave you an analogy of somebody jumping from an aeroplane. Though that person is coming down, but the pace at which this person is coming down is lower. And the last thing, guys, is D, which is apply convexity. How did we apply duration? We took the duration. Here I'll take the convexity, same thing. What do? You multiply that with the value of the bond. Here also I'll multiply with the value of the bond. Multiply by change in market rate. But here I'll take the change in market rate ka whole square. Why do I take change in market rate ka whole square? Because while calculating it, we divide it by change in market rate ka whole square. So while applying it, also I'll multiply by change in market rate ka whole square. And the 2 which was missing before, I'm going to divide this number by 2. अगर यहीं पे अपन 2 से divide कर देते इसको, so this would have become 50. And then I don't have to divide by 2. But because I didn't divide it by 2 there, I'll divide it by 2 here. So guys, the impact of the convexity is equal to 5. It means that if I tell the investor somehow that this is the value of the bond excluding convexity, what is the impact of convexity? Convexity is equal to 5 rupees, what we just calculated. So the value of the bond including convexity would be equal to 945 plus 5. Convexity is always positive. And 1055 plus 5 because convexity is always positive. And this market value will be equal to the reality. So what we are doing is we are trying to figure out the difference between the black curve and the brown line with the help of convexity and applying convexity, and we get a difference of 5 rupees.
Ansh, can you please repeat once how we have calculated the impact of convexity?
Okay, so how did we calculate the impact of the duration? We took value of the bond multiplied by the YTM of the bond multiplied by the duration, right? Here also I want to like draw an analogy with that. Here I'm doing a similar thing, but because I'm applying convexity, I'll take the convexity here. And because I divided by YTM ka square, I'll take YTM ka square. And because I did not divide it by 2 while calculating convexity, I'll divide it by 2 here. So I did value of the bond, which is 1000 into change in market rate ka whole square into the convexity itself, which is equal to 100. And if I divide it by 2, I get 5. So there's lots of different similarity between this and this, just that rather than YTM, I'm taking YTM square. Rather than duration, I'm taking convexity. And I'm dividing it by 2 because I didn't divide it by 2 here.
Sir, what is 100 means?
Ansh, your voice is not very clear.
Sir, what is my 100 means?
Oh, that 100 just like doesn't mean a lot. Like it's difficult to explain. So when you talk about second derivative, you cannot explain it. Like if you did quants, what is variance? You can't explain it. Standard deviation you can explain. How do you explain variance? So this is like a full-fledged example, guys. So we started with this point. If we calculate duration, applied duration, we came here, but these numbers were lower than these numbers. What was the gap? It was because of convexity. We calculated convexity and applied convexity and we got the numbers. What was the starting point? So this covers four important things: how to calculate duration, how to apply duration, how to calculate convexity, and how to apply convexity. So what we will do is we'll take a break, and after the break, we'll start doing an example. Like we'll do one practice, okay? And then we'll take it from there. Okay. So it's 11:50, guys. Let's be back at 12:10, and then we'll continue. Okay, guys, welcome back. Please switch on your camera when you're back so I know that you are there. So let's take an example and let's try doing it ourselves, like all the four things: calculate duration, apply duration, calculate convexity, and apply convexity. It'll take like 10 minutes to do this before we go to the next topic. So let's assume that the current face value is equal to 400. The coupon rate is, let's say, equal to 12%. And I'm saying that if the market rate is currently 12%, obviously the market value will also be equal to 400. But I'm giving you two scenarios that when the market rate goes down to 11%, let's assume that the value of the bond goes up. And let's say the value of the bond goes up to 420. And when the market rate goes up to 13%, the value goes down, but the decline has to be lesser than 20 rupees. Let's assume that the decline is equal to 18 rupees. So the value will be equal to 382 rupees. So with these numbers, I want you to calculate the four things, what we calculated above. But I want to, once you apply duration, I want you to also calculate market value excluding convexity. And once you apply convexity, I want you to calculate market value including convexity. Okay? So let's get started. You got 5 minutes. And let's connect in 5 minutes and keep asking me questions. I'm around. If you get stuck and if you need any help, the best way of doing it is like do not look at the formula. Try doing it without using the formula. Because you know the logic and you know the broad idea.
So the duration is 4.75.
Keep calculating and just keep putting that in the message chat so that others do not get biased with your answers. And I'll be able to keep a track as well. Ansh, check your answer for duration. Rakesh, Ria, and Rakesh, Ria, and Samay. I think you got the right answers on the duration. Waiting for others. Yeah, Ansh, now your answer is correct. Nandini, no. I think the mistake you're doing there is that you're taking the market value of the bond to be 100 rather than 400 in one of your calculations to calculate duration. It should be divided by 400, not 100. So because of that, everything else is wrong as well. Samay, I think yes, your applying duration and everything looks good. Sovic, yes, the value without convexity looks good.
Sir,
Yeah.
sir, you have said two statement regarding convexity and duration. Duration is what actual price what reach, and convexity is which we expected. Something you said
No,
that.
no,
Can you
no,
please
no.
repeat?
So I
Yeah,
said
sir.
that the brown line or what we tell to the investor or what the duration is will tell you the change in the market value with the change in market rate. But in reality, the value of the bond does not go up to the extent of duration. It goes up much more. And in case of an increase in market rate, the value doesn't go down that much. It goes down much lesser. So, the black line is the reality. The brown line, what we are telling the investor, the straight line is what you can calculate using the duration. And the gap between the brown line and the black curve is nothing but the convexity. Okay, so let's start with the first one, calculate duration. So if there is a decrease in market rate by 1%, the value of the bond goes up by 20 rupees. But 20 rupees is equal to what? 5%. So this is the mistake I think, Nandini, you were doing. You're taking 1% and here you were taking 20%. But it's not 20%, right? It's only 5% because the base is 400 rupees. So if 4 becomes 420, the increase is 5%. So here my duration is 5 times. Here the impact is 4.5%. So the impact is 4.5%. Sorry, 4.5 times. In दोनों का if you take an average, in दोनों का average will be equal to 4.75. This is using the logic, we could calculate it. But if you want to use the formula here, what is the value of the bond with a decrease in market rate? 420 minus the value of the bond with an increase in market rate, 382, divided by 2 into value of the bond multiplied by the change in the market rate. So the total impact is 8. If I do 38 divided by 8, I get 4.75. So that's your first step. What is duration here? The duration is equal to 0.75, 4.75. How to apply duration? That's pretty simple. Duration multiplied by the value of the bond multiplied by the change in the market rate. So the impact of the duration would be 90. It would mean that if it's 420, sorry, the 400 will become 420, 419, and the decrease will be 19 as well. So it'll become 381. So these are the values excluding convexity, which many people got it right, including Sovic. Sovic, you changed your answer and got it wrong. पहले सही था. And Samay got it right. Okay. The third step is calculate convexity. So in this case, what is the formula for calculating convexity? But even if you don't want to use the formula, we are telling investor 4.75, but the reality is 4.5 and 5. So the gap is 0.25, right? So the formula here is what is the value of the bond with a decrease in market rate plus the value of a bond with an increase in market rate minus the present value into 2. And if you divide this number by 400, which is the current market value, into the change in the market rate and divided by 2. So guys, this 2 by 8 is nothing but 0.25, which is nothing but the gap between 4.5, 4.75, 5 versus 4.75. But as I told you that at this stage, we don't divide it by 2 and we take a square of this because it's a second derivative. So these are the two changes I did. So if I do 2 divided by 0.04, I'm getting a convexity of 50. I think many of you got it right, including Souvik, Rakesh, Nandini. Duration of 50 is correct. The last step is how to apply convexity. So to apply convexity, I'll take convexity times the change in market rate. But because while calculating it, I did a power of 2. While applying it, I'll do a power of 2 into the value of the bond. and we didn't divide it by 2 at the time of calculating it. So I will divide it by 2 while applying it. So the total impact of convexity is 1. So here, like the benefit of convexity is 1, is always positive, whether there's an increase or a decrease in market rate. So if we include convexity, it'll become 419 plus 1, it'll become 381 plus 1. And these are the values which is including convexity. And these are the numbers which are exactly the same numbers as these numbers. It means everything and anything we have done looks logical. See, your books have done the exact same thing, but what I don't like it is like they've done it in like 4 different places. And people never get a holistic view about it. कि हो क्या रहा है? Though we spent like an hour and a half almost discussing it, but अभी कहीं confusion नहीं होगा तुम्हें कि ये क्यों कर रहे हैं? What is this? What does it mean? Convexity can never be negative. Remember it. So the impact from convexity can also be never be negative. It will always be positive. Okay. So we'll scroll through the text and everything just to make sure that we covered everything. But this is mainly these next 2 chapters. So whatever is the macro duration, if you divide it by 1 plus r, I use the word effective duration, guys, but you call it modified duration. Effective duration is we calculate using the formula, but the modified duration and the effective duration are very, very close to each other. So let me repeat. Macro duration is what is the weighted average time in which you will get your money back. Effective duration is using the formula here, which is the value of the bond with the decrease in market rate minus the value of the bond with an increase in market rate, what we just did some time back. If you divide the macro duration by 1 plus r, you get a modified duration, which is very, very close to the effective duration. So there's no difference between modified duration and the effective duration. Broadly, they are one and the same thing. And how do you calculate it? What is the modified duration? Nothing but macro duration divided by 1 plus YTM. How do you calculate the modified duration? Value of the bond with a decrease in market rate minus value of the bond with an increase in market rate. This is the formula, we just utilized it. So what we are telling investor is that you are going to go on the slope, which is the black line at the bottom, but you actually go on the line with the curve, which is the blue curve. Now there's a concept called money duration.
So,
So
what is that approximate slope of tangent line? This
so
can what this
is nothing but the tangent, the line which is tangent to this blue curve is nothing but the slope of the curve, which is nothing but the duration.
Okay, so the both tangent and approximate slope of tangent line both are
Forget
the
about the
slope curve
approximate
only.
slope. Forget about the approximate slope. This tangent line. So at this point, this is the slope. At this point, this is the slope. So what they're trying to say is the slope keeps changing at different points of the circle.
Okay.
So don't bother about the approximate slope part.
Okay.
Now we calculated the duration, but there's a concept called money duration. What is money duration? If you take the duration and multiply by the value of the bond. So in the example, we had the duration to be equal to 4.75. If you multiply that 4.75 with the value of the bond, it'll become 19 rupees. So rather than saying 4.75 times, you can say 19 rupees. It means for every 1% change in the market rate, the impact on the value of the bond will be 19 rupees. So when you convert the duration into the dollar amount, we call it money duration. It's very simple. You can convert it into price value of a basis point. So what I can do is, while applying duration, I would say, okay, the duration is 4.75. The value of the bond is 400 rupees. But as I told you that this is for 1% change. But let's say if this is 0.01% change. So the value of the bond will change by 19 cents. So this is what we call as the price value of a 1 basis point. It means if the market rate changes by 1 basis point, which is equal to 0.01%, the value of the bond will change by 19 cents. Why are we calculating all of this, guys? One thing is how to calculate, that's very simple. But the more important thing is why do we calculate it? Investor क्या करेगा? He'll simply look at अच्छा आज market में क्या हुआ है? अच्छा market में the market rate has gone down by 2 cents, 2 basis points today. Oh, that's a good news. The value of my bond has gone up by 38 cents. I've got total 100 million bonds. So I made this much of profit today. So she or he will always have a broad idea how much profit or loss they are making on a particular day.
Sir, sometimes we decide that bond value will decrease or increase by this much percent, 1% or 2% or whatever value we decide of the basis point. How we will take or realize that that particular percentage of decrease or increase value, sir? I mean, what is the assumption behind that
No,
value?
the question will give you. So I can change it with whatever number you want. Like if you don't want to
No,
change
sir.
increase or decrease by 1%, increase or decrease by 0.5%.
Okay.
The numbers will change, but the end result will be same as this.
Okay. Yeah.
So whether we take 1% increase or decrease or 0.5% increase or decrease, it depends on the economy, right? In real world. If you think it's very
Yeah.
volatile,
Yeah.
you take a difference of
Yes.
0.5%, 1%. But if it's less
Yes.
volatile, I'll take a difference of 0.05%.
Okay.
Okay, guys, so this is the broad topic, what we already covered, the duration part, and then there's a convexity part, which we also covered. So the investor will think that he's always on the black line, but actually he's traveling on the blue curve. It means the decrease will not be that much, the decrease will be flatter, and the increase will not be just this much, the increase will be lot. So the difference between the black line and the blue curve is nothing but the convexity ka benefit. We already calculated the duration, we already calculated the convexity, we already applied the convexity. So we've done all of it, guys, okay? So this is what they are saying, like this is that benefit of 1 rupee in our example, which is coming from the convexity part. Now, within a portfolio, you can have multiple bonds. Let's say bond 1 has a duration of 3 years, bond 2 has a duration of 5 years, bond 3 has a duration of 7 years. So think about, let's say there's one bond on which you invested 20% of your money. Uska duration is 4.17 years. But there's another bond where you invested 30% of your money, and the duration of that bond is 7.25 years. And there's another bond where you invested half of your money, where the duration is just 2.454 years. So you're not interested into knowing the duration of each and every bond. You want to know the duration of your portfolio with these three bonds. So you can say, okay, for 20% of my portfolio, the duration is 4.17. For 30% of my portfolio, the duration is 7.25. And for 50% of my portfolio, the duration is 2.54. So the weighted average duration of my portfolio is 4.28. So that's a very simple thing. This will help you to calculate the portfolio duration. And that brings us to the next topic, which is curve-based and empirical fixed income risk measures. But before we do that, I'll stop here for a few seconds. Ask me any doubts, any questions, any comments you have. If you don't tell me, guys, I won't know. So please be upfront. There's no, you should not be hesitant. Okay. So this topic, there are a couple of very important things which I want to talk about, which is reading number 61. Let's say if it's a call, guys, there's a bit of repetition from the previous topic. What is effective duration? Again, they're given the same formula. What is effective convexity? They're given the same formula, right? Nothing changes. But the point here is, let's say if it's a callable bond versus a puttable bond. So what they're saying is, if it's a plain vanilla bond, as in there's no call option, there's no put option, the slope of the curve would be this dark blue line, the solid blue line. But if it's a callable bond, if the market rate comes down, the management has an option to buy the bond back. So think about, the management is giving a coupon rate of 12%. The market rate has come down to 10%. The management will think, why am I paying 12% when I can give a new loan into the market at 10%? So they'll try to buy back the bond. That's one logic. The second logic is, if the market rate is lower than the coupon rate, the bond will be trading at a premium. And let's say the management has an option to purchase it back at a $101 or $99. They'll purchase it back because they're getting something worth 110 rupees for only 99 rupees or 101 rupees. So in either case, when the market rates are lower, the company will buy those bonds back. So in this case, what's happening is that when the market rate goes up, these bonds, the callable bonds, the dotted line, is behaving just like a plain vanilla bond. But with the decrease in market rate, the value doesn't go up, the value becomes flatter. So in this case, actually the better way of doing this chart is, let's say this is plain vanilla bond, which is the black line. A callable bond, on this side it will be similar, but on this side, rather than going up, it'll become flatter. So this part is common, whether it's a callable bond or a plain vanilla bond. Why it's common? Because if the market rate, let's say, goes up to 14%, companies paying only 12%, are they happy paying 12%? Yes, they are very happy. But in other words, the bond is trading at a discount. The company can purchase it back at $99 when the market value is 95. Will they purchase it back? No, they won't purchase it back. Right? So in this case, the right side of the chart will remain exactly the same. But on the left side, when the price of the bond should go up in a plain vanilla bond, in case of a callable bond, it won't go up, it'll become flat. Why to become flat? Nobody will be ready to pay a huge premium for this bond, but they're always scared that company can come and buy the bond back at the pre-decided price. So let's say if the pre-decided price is $102, it will never go beyond $102. So guys, callable bonds, are they good? Because when the market rates are going up, the value goes down. You lose money just like a plain vanilla bond. But when the market rate comes down, the value should go up. But unfortunately, the value is not going up. So the callable bonds are not good for the investors because with the decrease in market rate, they would not benefit. In other words, the black line or the black curve is convex. Convexity is good. Why do we call it convex? Because it's facing the origin. Sorry, its back is towards the origin. But see this chart, इसका face, यहाँ पे इसका face देख रहे हो, right? Its face is towards origin. It's concave. Or it's called negative convexity. If convexity is good, negative convexity is bad. So guys, concave callable bonds are not good. So what is the call option value? If it was a plain vanilla bond, the value here has been 100, oh sorry, 110. But because it's callable, the value is 101. It means that the value of the call option here is $9, but that option is not with you. The option is with the company. If the market rate increases, the value of the callable bond and the plain vanilla bond is same. So we say that in this case, there is no value of the call option because whether it's a callable bond or a non-callable bond, it does not matter because company is not going to exercise the option. So one key takeaway, if convexity is good, callable bond will have a negative convexity and that's bad for the investors. And if I do a similar chart for a puttable bond, the puttable bond will be similar on the left side of things. What is puttable bond? You can sell the bond back at a particular price. Will you sell a bond back at a particular price when the market rates are lower? It means you are getting 10%, but the market rate is 8%. You'll be more than happy to continue with that. Or in other words, the value of the bond is at 110. You have an option to give it back to the company at 101. Will you use that option? No. But on the right hand side, when the market rates have gone up to let's say 14%, you're still stuck with 12%. You want to give the bond back to the company. Or when the market rates go up, the value will be trading at a discount. You have an option to give it back to the company at par. So in this case, if I try to draw a chart here, this is what a plain vanilla bond will look like. But if it's a puttable bond, this side will be largely similar. But on this side, guys, it'll be like this. Why it will be like this? It won't go below $99 or it won't go below $98 because the investors know they can sell it back to somebody else at $98. If not somebody else, they can give it back to the company at $98. So guys, the black line is convex. Convexity is good. The brown line is even more convex and higher convexity is even better. So that's the reason puttable bonds are always good. And the value of the put option is the difference between this point and this point. This is the value of the put option. And because the investor has a put option, the value of the puttable bond will always be more. And if you go on the left side, when the market rates are coming down, the put option has no value because the investor will never give it back to the company. So the callable bond looks similar on the right side and the puttable bond looks similar on the left side. In case of callable bond, on the left side, it becomes concave, which is bad for the investors. And for puttable bond, on the right side, they become even more flatter, which is even better for the investors. So this is the key thing, guys, and a key point here in the entire topic. Take a minute, ask me questions.
Sir,
Yep.
sir, you said that convexity never be negative, but in callable option, callable bond, is that possible? The negative convexity
Yeah.
there are
So in a plain vanilla bond, convexity will never be negative. But yes, callable bond is an exception with a decrease in market rate. the callable bond can show a negative convexity. So there's only one exception to what I said, and that's a very good point. That's a very good catch, that the convexity can be negative only in case of a callable bond, only with the decrease in market rate.
If it is negative convexity, so then it will negative impact for the company, correct?
Now for the investor,
Sorry, for the investor.
yeah, that's right. It will be a negative impact for the investor in that case.
Is a similar case in put table bond as well, sir, or not?
In case of putable bond, it can never be negative convexity. It's just a higher positive convexity. So the black line is convex, but brown line is even
Okay.
more convex.
And then that will be negative impact for the
Company,
company.
yeah. So जिसके पास option है उसके लिए positive impact है. So callable bonds are with the company, like company has an option. So it's good for the company, bad for the investor. In case of putable bond, the option is with the investor. So it's good for the investor, bad for the company. ठीक है? Wait. Okay, there are a couple of things you can read through it, like key rate duration and stuff. Nothing much. Like the concrete part here was the callable bond and the putable bond, what we discussed. Now there's a bit of theory. So we'll do a bit of theory. So we are left with 6 readings: 62, 63, 64, 65, 66, 67. But I want to, let's go in that order. Let's not change the order. So when we talk about fixed income, the key thing we have discussed about is the default risk. Like whether the person will be able to give you the money back or not. So in this case, the credit risk means what could be your loss because you're giving credit to somebody else. It could be because that person defaults. It could be because that person delays the payment. It could be because of like illiquidity, that you cannot get your money back when you want it. It could be anything. Before we get started, guys, and go further, can I request all of you to please switch on your cameras? Nandini, thank you. Appreciate that. Rishabh, you also had it on most of the time. Thank you. Rakesh, I won't take any question from you if you do not switch on your video now. Anushka, Ria, you had your video on at the start of the session, but not seeing you now. Wow. Thank you, guys. You just need a reminder. Otherwise, you're nice people. Okay. So in this case, whenever we give a loan or we give a credit to somebody, we look at 5 C's. What are those 5 C's? One is the capacity, and the second one is character.
Papa, this one is better than last time.
So capacity means, let's say if Mr. Ambani asks you for money, or another versus another bankrupt company asks you for money, you'll be more than ready to trust Mr. Ambani. Why? Because Mr. Ambani has the capacity to give you the money back. Why Mr. Ambani has the capacity to give you the money back? Because Mr. Ambani has a nice earning power. He has got a huge wealth. So you get some comfort that Mr. Ambani has the ability to pay the money back. Okay? So no wonder the banks are more than happy to give a loan to salaried people rather than those people who are unemployed. But ability is just not enough. For example, Mr. Vijay Mallya, well, let's not talk about it. Just because you have money, there's no guarantee that you get the money back, right? So the second thing what you're looking for is the character, the willingness. Whether this person has a willingness to pay the money back or not. So guys, only ability is not enough. You have to look for willingness, which is character. But only character is not good enough. The important thing is capacity as well. So there was a house help, and she was saying that she wants to start a nice big restaurant, and she wanted 15 lakh rupees. And we knew that she's very honest, working with us for last 10 years. We can trust her. So the problem was not with character. The problem was with the capacity. Because her business plan was a bit flawed. She did not have a proper business plan. And if the business plan fails, she doesn't have any way she could give us the money back. So we said no to. So all I'm saying is only character is not good enough. The capacity is also important. Okay? So the way I look at capacity is the ability, the character is the willingness. But guys, when you invest money, if somebody has the ability, somebody has the willingness, that's not good enough. So recently I took a home loan. What they did was they asked me for a salary slip. Acha, he has the capacity. They took my CIBIL score. That shows my character. If I paid money to other people in the past, if I pay my credit card bill on time, there's a chance that I'll pay them money on time. So CIBIL score technically is nothing but the character certificate in case of India when you go for a loan. But was bank comfortable with that? They were asking me questions. What if you lose your job? And they went to the extent that what if you die? Oh, they didn't say it. They put it very, very politely. They said, if you take a life insurance, we can give you further discount on the interest rate we are charging. You understand what they're saying technically? That they are concerned, what if I die? And given the home loan is for next 20 years, is not for next 20 days, that's a fair concern. So they wanted my life insurance. Just in case I die, the money can be paid through my life insurance. And the life insurance amount has to be equal to the value of the house. Sorry, it should be equal to the value of the loan. And another thing they wanted is they wanted to make sure that all my original papers, like the registry papers, the sale agreement, the ownership papers, are with the bank itself. And they made me sign everything saying that I cannot do anything with the house unless I pay the money back. So I have the character, I have the capacity, still they wanted the collateral. Collateral means a safety deposit or something as a mortgage. That if I don't pay the money back, they can sell my house and get their money back. So this is what we call as collateral. Was that enough? No. I should have shown you, like I signed at least in 150 documents, 150 papers. Big like 50-page document, sign here, sign there, or put a sign there, put a stamp here. It took me like almost like 1 hour to sign all the documents because they have put so many terms and conditions and agreement which I have to agree to so that they can drag me to the court if I don't do anything what they want me to do. So guys, capacity is the ability, characteristic is the willingness, but that's not enough. They still ask for a collateral and they still ask me to sign on the agreements. And they also look for my life insurance policy. And they said, Acha sir, you have other couple of houses. Can you give the papers for those houses? I'll say, like, why should I give you those houses? No, just in case you die, just in case your life insurance company doesn't pay up, just in case you're not able to sell this property, we'll sell those properties and get our money back. I said, get lost. If you can give me the loan based on my capacity, character, collateral, and covenants, give it to me. I'm not ready to give you any further capital to sanction my loan. So then the bank said, okay, you get lost. We don't want to give you the loan. So finally, I had to give them the property papers of one more property so that I can justify that I'll give them the. So guys, these are the 5 C's what a lender will look when they're giving a loan to anybody. And this will feel like, yaar, this is like being super safe. But still the lenders will lose their money because the borrower will default. Okay? You generally do a top-down approach. Top-down approach means even before you look into how safe it is to give money to Ansh, you generally do a top-down approach. You look at a very broader picture. In 2008 and 9, even the most ethical people, even the most rich people, even the most profit-making companies defaulted. क्यों? Market condition ही ऐसा था. They were not getting their payments. They were not able to sell their inventories. They were not getting any business. They don't have a choice but to default. And when the markets are good, like in 2006 and 7, even Vijay Mallya was paying his debt very, very regularly. Because everybody is making profit. They are not losing out money anywhere. They are making huge profit. So as a result, that's the number one condition. The number one thing, guys, you look at is the economic condition. Be ready to give money when the economic conditions are good, and don't lend money when the economic conditions are bad. The best time to give the money is when the economic conditions are bad and you think it'll become better. Because given the economic conditions are bad, you'll get a very high interest rate. But given the economic conditions will become better, your risk will not be that high. The second thing is you look at the country. I will never ever give a loan to, let's say, a country like Bangladesh or Sri Lanka or anybody in those two countries because the country itself is facing a financial issue. The third thing is look at the currency. Given the country is facing issue, even the currency in those countries are facing issues. So these are the 3 C's I generally look at: condition, country, and currency. The corporate debt can be secured or unsecured. Secured means they'll give you some collateral in the form of machinery, power, and plant. Like they will keep it, they'll keep using that machinery. But if company is not able to pay the debt, you will get the first right on that machinery to sell in the market and get your money back. The debt can be a sovereign debt, which is issued by the central government. Now, there's something called a cross default clause. So, what does it mean? Let's say I've taken money from Anushka, I've taken money from Nandini, and I've taken money from Rakesh. Okay. Anushka ka payment, I make her the interest payment every 30th June. Every year I make the payment to Anushka on 30th June. Nandini ka I make the payment on, let's say, every 30th April. And Rakesh ko I make the payment every 31st of December. Now recently Nandini's payment was due and I defaulted the payment. I couldn't pay her the money back, the interest amount due. Is Nandini concerned? Yes, she is concerned. But my question is more about Anushka and Rakesh. How do you feel? Are you concerned? And don't tell me you're concerned about Nandini. It's a very, very selfish world. You're concerned about yourself. That if I could default on Nandini, I can default on you as well. Is it logical? So in this case, a cross default, but can you go after me yet? Can you drag me to the court and do anything about it? No, you can't. Given, did I default on you yet? No. So you're like, he's going to default on 30th June. You know for sure that I'm going to default, but even then you can't do much about it. So in this case, there could be something called cross default clause. The cross default clause means that the minute I default on Nandini, it will be assumed that I've defaulted on everyone. And this will trigger that all these three people can drag me to the court and ask me for things in case I default. So Anushka and Rakesh doesn't have to wait for me to default on them and to go so that they can go after me. Just because I defaulted on Nandini, they can go after me because it'll be assumed that I've defaulted on everyone. If there's a clause called cross default clause. And there's another thing called paripasu. It means that once I've defaulted, though these are three different loans, maybe one is a senior loan, the other one is a junior loan, but paripasu clause would mean that all of you get a similar right against me in terms of selling my assets, in terms of getting my money back, and all of that. So these are two important things. A cross default clause means that a default on one bond issue causes a default on all the issues. If I default on Nandini, technically I default on Rishabh, Anushka, and everyone. Paripasu clause means all bonds of a certain type rank equally in the default process. How do you measure a credit risk? Remember, we did this exercise. There are two things. One is probability of default, and the second is loss given default. Remember, I took an example of two friends of mine. In one case, the probability of default is very, very high. So this person will keep defaulting. So rather than making the payment on 31st December, he'll make the payment on 2nd January. But the loss given default was very minor because I'm just losing the interest for 2 days. In another case, a friend of mine, he never defaulted because he'll always make the payment on time. But only 1 out of 100 times he delayed the payment. And in that case, my loss given default was quite significant because I could never recover the money. So the probability of default is whether somebody will default or not. What is default? Even if you do not make the 1% payment by the due date, you delay the payment by 1 day, you have defaulted. But that may not mean that there will be a loss. The loss given default could be different depending on how much amount you can recover. So if my friend doesn't pay me 1 lakh rupees on 31st December, but if I can get the money back from him on 1st January, technically I could recover all the amount from him. So the loss given default is 0. So if you multiply the probability of default with the loss given default, you'll get the actual expected loss. I've done this part in a great detail with lots of examples. If you still want me to redo it, let me know. So the credit spread or the credit risk is nothing but what is the probability of a default? And the second thing is what is the loss given default? So if somebody defaults a lot and you're not able to recover lots of money, you're going to charge lots of credit spread on that. Cool. Now, there are lots of credit rating agencies. Like in case of India, it's CRISIL, ICRA. If you go to the outside world, like the global thing, we have S&P 500, we have got Moody's, we have got Fitch. So these are the companies who will do the credit rating of the companies. They give a AAA, AA, those kind of credit ratings. Now, in this case, you can get an idea looking at the credit rating whether it's safe to invest in one company's bond versus the other company's bond. If you invest in a AAA rated bond, it's very safe, but the returns will also be very, very low. If you invest into triple B, double B, and B, the returns are higher, but the risk is also higher. In case of double C, C, and D, you can lose money, but if you make money, you can make huge amount of money, more money than what you can make in the equity markets. Now, there's something called credit migration risk. Where does it get the name migration? Generally, like the birds migrate from North Pole to South Pole and from one area to another geography, depending on the weather conditions, right? How do you think the migration happens? Like they leave at different point of time. 10 birds will leave today, 20 birds will leave tomorrow, or they go in like a one big group. So there have been lots of pictures from National Geography, like, they're smart enough that they travel all together. But then you can increase the speed because, like the air you cut through, it increases the safety. And it's like just like lots of other things because the migration from one area to another region is going to take you like a couple of days maybe to migrate. So in this case, the credit migration risk means that if the market conditions go bad, if the company defaults on one loan, or there's a credit rating downgrade, it just impacts other covenants in the agreement as well. So let's say my one of the covenant is I will not delay the payment. But let's say it was a very bad year for me. The payment got delayed. The second thing is I should not take a further loan from the market. This is the exact point of time I want to take further loan from the market because I'm making lots of losses. The third agreement could be that I should not, the third contract should be no, that's very technical, guys. EV by EBITDA ratio, but we'll do it only once we get into financial risk, financial statement analysis chapter. So let's skip that. The another clause could be that I should have at least this much money in my bank account, but when there's a loss, I don't have that much money in my bank account. So there could be lots of issues, and one issue can lead to the other issue. So that's the whole point here, that a credit rating downgrade will decrease the value of the bond and potentially trigger other contractual clauses. This is what I was telling you about AAA, AA. But guys, within AA, they can give you AA plus, AA minus. Why? That's the logic here. So if let's say you currently the company is at AA, the credit rating cannot make it A all of a sudden. First of all, they'll say, hey, though the rating is still AA, but we have a negative view on the company. So this is what we call as AA negative. And if that negative view stands and the company deteriorates further, they will call it rating A. Within A, if they want to go to triple B, first of all, they have to say, hey, it's an A with a negative view, and then they convert into triple B. So the market will always know when there is going to be a credit downgrade, because before going for a credit downgrade, for the existing credit rating, they give a negative view on the company. Okay. Anything above triple B is investment grade. Anything below triple B is a non-investment grade. So all these things here are triple B rated. Like this part above this is investment grade. But यहाँ पे अगर तुम देखोगे, इसके नीचे जो भी है, these are non-investment grade. तो guys, sorry, ये जो है लेफ्ट पार्ट के अंदर, give me 1 second. ये लेफ्ट साइड के अंदर जो भी है वो इन्वेस्टमेंट ग्रेड है, क्योंकि ये या तो ट्रिपल बी है, ट्रिपल बी से ऊपर है. जो भी राइट साइड में है वो ट्रिपल बी से नीचे है. सो दीज आर नॉन इन्वेस्टमेंट ग्रेड. Investment grade where all the retail investors and the laymen can invest money, क्योंकि they are pretty safe. But if you're investing into non-investment grade, you should have a technical knowledge. You should be an institute or a person with lots of money and knowledge about the fixed income market. I think we have touched upon it in the past as well. But triple B and above is called investment grade. उसके नीचे everything is a non-investment grade. Now, the main point here is that if the credit rating agencies give you the credit rating, and if you invest money into AA, A, triple B rated bonds, they will never default. Because before they default, the company, the credit rating agencies like CRISIL, ICRA, and CARE, they will downgrade the stock, they'll downgrade the bond. So that way, like credit rating agencies are very good. They tell you when the company is going to default, and you can take the money out before you default, before the company defaults. So, guys, what do you think about credit rating agencies and the credit ratings given by these agencies? Aren't they helpful if you want to invest money in the fixed income market? Yes, that's helpful. But let me tell you a matter of fact. You know Satyam, right? Satyam Computers.
Yes.
They defaulted. And before they defaulted, most of the credit rating agencies had a double A or A rating on the bond. They thought it's pretty safe. And in next 10 days, they defaulted. And after they defaulted, CRISIL and ICRA, they said, hey, it's not a double A rating bond, it's a D rated bond. But by that time, you already lost your money. So there was a particular stock on which the share price was 100 rupees. Okay. And that stock went down from 100 rupees to 20 rupees. When it was 100 rupees, all the sell side investment banks, they were saying, hey, it can go to 110. Somebody was saying it can go down to 90. Somebody was saying it can go to 120. But nobody said it'll go down to 20. But something happened and the stock went down by 80%. The stock became 20. After it became 20, this person said, hey, there's some problem with the stock. It's not worth 120, it's worth only 22 rupees. This person said, I told you it'll go down. It's just that I didn't know it'll go down that much. I still will go further down, it'll be worth 18 rupees. But my point is that when the stock was worth 100 rupees, did anyone tell you that it's going to be worth 20? No. And these banks start telling you that how it makes sense to be around 20 when it has actually fallen down to 20. How good it is? Isn't it useless? And maybe like rubbing of salt on your wound. अरे मुझे तो पता ही था. अरे पता था तो पहले बताते ना. Then I would have taken the money out of the market. It's like, I was telling my kid, he was playing this early morning, and that's the reason I got a bit delayed as well, along with the technical issue. He fell down. So गिरने के बाद, I told my son, see, I knew that you're going to fall down. Then he says, if you knew that I'm going to fall down, why didn't you tell me before I fell down? How does it make sense that you're telling me after it? Unless you wanted me to fall down. Like amazed, yeah, that's like a very nice logical question. I'm not helping him by telling him after he has fallen down that you can fall down. So guys, this is exactly the credit rating agencies do. After the bond has defaulted, they tell you, hey, the credit rating is D. So they're reacting to the market conditions rather than being proactive. So this is the first and the most important thing. Credit ratings lag market price. They tell you what has already happened rather than what is going to happen.
Sir,
Yep.
सर जस्ट यू सेड दैट कि सत्यम का आपने एग्जांपल बोला उन्होंने डिफॉल्ट होने के बाद दे प्रोवाइडेड द रेटिंग ऑफ द डी करेक्ट सर
Yes.
सो वो लोग प्रीवियसली एनालिसिस करते हैं ना सर दे यूज्ड टू डू एनालिसिस बिफोर गिविंग एनी क्रेडिट और द व्हाटएवर दे विल प्रोवाइड ट्रिपल ए और ट्रिपल बी
Yep.
so why they will not I mean rate before itself sir I mean what is the major reason behind that
हाँ,
I mean
मतलब जब ये इतना पैसा लेते हैं लोग क्रेडिट रेटिंग वाले and
no.
this is their job, yes, they should have done it. But going by that
But
logic,
But as per my knowledge, Moody और CRISIL ये तो बहुत reputed. I mean सब लोग credit rating never they will. I mean कुछ politics वगैरह कुछ भी नहीं करते मैंने सुना है सर जहाँ तक.
नहीं, politics, let's not get into it. It's a very bad time to talk about politics. Very sensitive time.
Okay.
So I'm just saying that way, if you go to Fortis and Apollo Hospital, nobody should die, given they're like the best doctors. If there's a particular, if you buy something from, let's say, Casio ka calculator should never default because it's a Casio ka calculator. A CFA charter holder should always get a job. But ऐसा कुछ होता नहीं, right? There are always exceptions. You miss. It's not an ideal world. जो sell side equity research analyst है, they should always know which stock is going to go up. They should always know which stock is going to go down. At the end of the day, ये जो credit ratings होती हैं, these are assumptions, these are estimates, these are guesstimates. How will they come to know that Satyam is doing some big accounting manipulation? They're not God. So
S&P
yes,
on
even
the
the credit
similar.
rating agencies can go wrong, and this is one of the things. Rating agencies are not perfect. पहली बात
At the
उनको
end they
पता नहीं
were.
है.
Yes.
उनको पता होता भी तो many times you miss.
Like S&P had done the similar thing in 2008. Like they knew the bonds were defaulting, but they didn't downgrade the rating.
Oh, that's intentional. वो next level है. पर मैं बोलूँ उनको पता ही नहीं होता कई बार. And some risks are difficult to access. जैसे मैंने बोला, right, कि there's some accounting issue. It's not come to the public light. How will CRISIL and ICRA come to know about it? Let's say, like there was a big thing happened in China, by the way. There were these companies which were in ed tech. Like they were providing education, but through tech. And they were like very good, huge profit making, big growth, huge valuations. But एक दिन पता China government आके क्या बोलती है? These ed tech companies in China cannot make profit. They cannot be run for profit. People were giving lots of value to these companies because they were profitable, they were growing. And let's say if China government says that you cannot make profit on education sector. Can you imagine what happened to the price of these companies? Make a guess. And these companies are not small companies, not like Baiju's and all, which are less than $1 billion. These are the Baiju's of 10 years back, like 20, 30, $40 billion companies. What happened to the market value? Just in a single announcement that the government said these companies cannot make profit. The values of the companies fell by 95%, 97%, 98% on a single day. Some people did the analysis that the total loss in the market value of these companies was more than the value of the Sri Lankan economy. So how can you expect credit rating agency to take that into consideration? कि अच्छा Chinese government आएगी एक दिन और ऐसा ऐसा बोलेगी and this will be the impact. You cannot do that. Or COVID-19 के time lots of companies defaulted. Are you expecting credit rating agencies to forecast COVID-19 to happen? 2008 and 9 recession आया. Were you expecting credit rating agencies will take that into account? No. So yes, there are some flaws, there are some gaps. And at the best case, like these are just your assumptions and the guesstimates. And you can go wrong in your estimates. But just because you can go wrong in your estimates, does it mean that you don't make an estimate? You still make an estimate. For example, for your CFA level 1, you all have made some plan, right? Like how you're going to study. Now be honest to yourself. Do you follow the plan on a day-to-day basis? No. But still you have a plan. You still refine the plan, update the plan. So guys, that's very important. That's very logical that you make an estimate, you go wrong on the estimate, you refine the estimates, again you go wrong, again you keep refining it. I'm not taking pride that I'm getting wrong on the estimates, but it's important. If you don't have an estimate, you don't have any direction. And in that case, even if you go wrong, you won't know how wrong you are. So you can rely on the credit rating agencies, but there's a flaw. You have to take it with a pinch of salt. And that's the main thing. Because there's a lag, they react rather than being proactive. Some risks are difficult to analyze and they are not perfect. Credit spread risk. Let's say I gave a loan to Rishabh, assuming that his risk is X%. So if I go to the bank and give a money to for my fixed deposit, I'm getting 7%. But looking at Rishabh's character, capacity, collateral, and the covenant and the capital, those 5 C's, let's say I'm ready to give a loan to Rishabh at 9%. It means how much credit spread I'm taking from Rishabh compared to my fixed deposit. In fixed deposit is 7%. From Rishabh, I'm taking 9%. So the credit spread I'm taking is 2%. Now, in this case, there's a possibility that Rishabh starts behaving very, very rudely with me. He starts being very, very opportunistic. He starts blackmailing me that, hey, if I don't give you money back, then what? All of a sudden, I think that if I have to give money to this Rishabh, the credit spread I want is 3%. But I've already lended him the money at 2% spread. So this is what we call as credit spread risk, that the credit spread can go up, but I'm still stuck with the 2% at which I've given the loan to Rishabh. And I cannot go to Rishabh and say, hey, I want my money back. He'll say, dude, the agreement is for 5 years. I cannot go and tell him that I need 10% rather than 9%. He'll again show me the covenant that, see, it's 9% for the next 5 years. So this is what we call as credit spread risk, is the increase in the credit spread, which will make it bad for the lender. Because I'm still stuck with the 2% credit spread. You look at the macroeconomic factors. Now, guys, in this case, what happens is that if the yield spread increases with maturity, in the sense that if I'm giving a loan to Rishabh for 1 month, क्या ही तो फर्क पड़ता है, right? But if it's 10 years, the impact will be more. The high yield spread tends to fluctuate more. So what happened? I don't know whether there's a chart they still provide. Okay, they don't have a chart here. Let me provide a chart. What happened during 2008 and 9 recession? Let's say generally this is high yield. These are the bonds which are like this volatile. So guys, this is 2%, this is 4%, this is 6%, this is 8%, this is 10%, this is 12, this is 14. So 8, 10, 12%, they are high yield bonds in Indian context. And the low yield bonds will be like around 4%, 5%, 6%. They are less volatile. Why they are more volatile here? Let's say अभी कोई war हो गया. War होते ही you start suspecting these companies whether you'll get your money back or not. But do you suspect the Reliance of the world or the Tatas of the world? No. So generally the high yield bonds are more volatile. The low yield bonds are less volatile. During recession or during the economic fluctuations, ये जो gap है, the required return on these bonds will go up. The required returns on these will also go up. But the increase will be a lot more for the high yield bonds. मतलब वहां पे rather than 7-8% you want 15-20%. यहाँ पे 6% की जगह you want only 8 or 9%. So during recession ये जो gap है that widens. And not only widens, अब यहाँ पे जो fluctuation होगा वो बहुत ज्यादा wide होगा और यहाँ पे जो fluctuation है will continue to be less wide. So coming back to the text, what they're trying to say here, high yield spread tends to fluctuate more then investment grade spread as economic conditions change. High yield spread can widen dramatically. So guys, remember like the red line, I just like increased it like crazily. You'll think like ऐसे थोड़ा ना होता, वो वैसे ही होता है guys. You know, it goes up like crazy. 8-9% become 15-20%. In times of crisis, as investors sell riskier assets and buy safer ones in flight to quality. They want to hold quality things with lesser risk. Nobody wants to hold a high risk thing. So the price for them drops quite drastically. So when you invest into the market and you're looking for the high yield bonds, make sure that while investing into high yield bonds, do a diversification. उससे क्या होगा? If one of the bonds default, at least you'll get high return on the other bonds. Look for capital appreciation because they're currently selling at a discount. So the value will go up and you can make money out of it. And they'll give you an equity-like returns. Equity-like returns means very high return. If the company does bad, your money is gone. If company does good, currently it's trading at a 70% discount, it'll become 100 rupees. So 30 will become 100. If it's a high quality bond with a AAA rated bond, how do you care whether the company is doing good or bad? But in case of high yield bonds with like triple C or double C, the value of the bond will fluctuate a lot more with the change in the quality of the company. So that was about the broader market. You look at the issuer or the company itself. How is the profitability of the company? What is the character of the company? Capacity of the company? You know, like you look at the issuer specific stuff. You look at the market factors. Liquidity कैसा है market के अंदर. So guys, you look at the economy, you look at the company, and you look at the industry. Just don't look at the company alone. The company अच्छी है but market conditions खराब है. In COVID-19, everybody defaulted, and in 2006 and 7, nobody defaulted. Okay? I know it was a bit of theory, guys. The next chapter is again theory. It's just like the theory will keep getting more complicated and a bit more technical as we go further. Okay? So we are left with these 5 topics, 63. But you'll see, right, 63 is just like we'll spend maybe 10 minutes on it. It's hardly 2 pages. 64, again, very theoretical, but we'll start doing a bit more quality theory. Again, a very small topic. 65 is going to become a bit more technical. Maybe I'll show you a video for you to understand what's happening here. But we'll discuss it a bit more slowly rather than doing it fast. But it's a very small topic. 66 is an extension of 65, just getting into a lot more technicalities. But again, it's a very small topic as well. And lastly, we'll close with 67, which is so 65, 66, 67. They are like a similar topic, but just getting into different segments. Okay. So we'll do lots of work on this, guys. And out of all the topics, I would say the reading number 67 is the most important and the lengthier one. So the amount of time we are going to spend on reading 67 is going to be same as the amount of time we spend on 63, 64, 65, 66 combined. So 67 is that important. So that gives you the agenda for the next class, which is tomorrow. Okay? And tomorrow we'll close fixed income. Keep your questions handy, guys, if you got any. We'll do lots of practice questions when we get into the crash course. Okay? I'll roll out the feedback form. But I'm around for next couple of minutes or as long as you need me for any questions you have. I'm so happy, guys. Zoho use नहीं कर रहे लोग. Zoho के अंदर, like if I want to roll out this feedback form, I have to roll out each and every question individually. If I have to give an right to for you guys to speak and to share your video, I have to give right individually. If you log off and log in back, again I have to give you right. It was a pain. Rishabh, I don't know what new batch are you talking about. There's a new batch being starting sometime soon. You can use your mic. Oh, starting
So the new
tomorrow.
batch is starting tomorrow. I'll be joining that batch from tomorrow.
And what's the timing?
Same 9 to.
Okay. No, tomorrow, I'm sure that I'm taking the
Yeah,
fifth
I'm
session.
talking the when 16 comes for this
अच्छा मेरे को
batch
नहीं पता
and
यार
the
मतलब see like the way it works I only know till tomorrow that like I'll be taking that session. What will happen next week onwards, I don't have the schedule.
Okay,
Usually
tomorrow
we have
Tarun sir is taking, I guess.
okay.
Yeah.
So on Monday or Tuesday, like I'll coordinate with the institute,
Okay.
either like another topic within the same batch or with the new
Hmm.
batch. I'll come to know only from the institute.
Okay.
Sir, is there any WhatsApp group?
अंश आपका आवाज नहीं आ रहा है मेरे को if you are trying to speak.
Sir, is there any WhatsApp group for this classes?
अच्छा WhatsApp group है क्या? Do we have a WhatsApp group here? I think we have it. Can you please share the invite for the WhatsApp group in the chat window? Let me allow you to share chat with everyone. And Ansh, you can use that link to join the WhatsApp chat. Please, someone put the link in the chat window. Thank you, Rishabh. Any other question? Any other comment? Anything you want to discuss about your CFA preparation? Feel free, guys. Rishabh, you can tell them if you don't want me to take classes.
I want you to say that's why I'm asking you.
Okay.
So I'm planning to write in November and my batch is starting tomorrow.
Okay.
So will it be the right time duration?
No, but 6 months is good. I won't call it 6 months anymore. I'll call it 5 months now.
5 months.
So I mean, like it's just like those 500 hours, right? Turn around those 500 hours. But can you do that in 1 month? No. Do you need 1 year? No. Now, whether you need 5 months, 7 months, 9 months, that depends a lot on your schedule and your ability. Like in terms of what else you're doing. Can you spend those 5 hours or 10 hours on a daily basis? Cool. Thank you guys and see you tomorrow.
Thank you, sir. Hope to see you in the next batch.
Same here.